Until the start of cash equities trading here in Europe for this Monday morning, here are your headlines. Crisis at OPEC Plus. Saudi Arabia stands firm amid the UAE's opposition to a production deal. Talks continue today. We hear from the energy ministers at the centre of that spat. Gaining steam, positive jobs data pushes the S&P 500 to its 7th record in as many days. US stock and bond markets are closed for the Independence Day holiday. And China's tech crackdown. Beijing blocks ride-hailing company Didi from app stores after its mega US IPO, citing security concerns. It's now widening the probe to other firms. Good morning, everybody. Let's take a look at the futures then this Monday morning, just coming up to 8 o'clock here in London. And European equity market futures flat to negative this morning. Flat here in the London market. Elsewhere, a little bit more negativity maybe on the CAC 40, according to this futures picture. But let's get to the start of the European trading day then, bearing in mind that we're without the United States today. US futures are open, US futures are pointing lower, but US futures will not lead into cash trading later on today because, of course, it is the January 5th in lieu of January 4th holiday over in the United States. So there'll be no cash trading. But as I say, US futures point a little bit weaker, and European equity markets just opening and opening fairly flat. So the Stock 600 is flat. The FTSE 100 up by 0.1%. The IBEX over in Spain down by 0.33%. The DAX and the CAC 40 both down by around 0.1%. So we're fairly flat overall. That is the big picture story here for European equity markets this Monday morning. Flat right now. Meanwhile, US stocks hit a record for the 7th day on Friday after the June jobs report signaled the economy is gaining steam. 850,000 new jobs were added, the most in 10 months. Joining us now is Morgane Deladon, Global ex-ETFs Director of Research. Morgane, very nice to speak to you. So we have this picture coming out of the United States of a sort of Goldilocks jobs report, not too hot because it doesn't lead people to really rethink what they thought the Fed was going to do next, but strong enough that it gives us comfort that the US economy is still recovering. How do you interpret what we saw on Friday in terms of that jobs data and the stronger risk asset moves in response to it?
Well, I think the market is cautiously optimistic about the U.S. recovery and how the Fed will react to these reports. I think over the summer, most market participants are expecting no change in the outlook from the Fed because there is still a lot of public aid for the job market in the U.S. However, in September, when these furlough programs will end, we will have a clearer picture on what's going on in the U.S. market, job market, and especially that we could then assess the question whether there is or not a shortage in the U.S. job market that could be more inflationary and then prompts the Fed to react quicker than what's currently priced in. So definitely September would be a right timing to reassess the strength of the recovery in the US, especially with also the fiscal programs in place.
Yeah, let me ask you about where you see stocks going then in the second half of the year, Morgane. I was looking at a piece of, some writing by our colleagues at Bloomberg News that talks about how investors still see, despite the fact we've seen records on US and global stocks, they still see further gains in the second half of the year. So BlackRock, State Street, UBS, JP Morgan, all talking about how there will be gains in the second half of the year. What's your perspective for your business? Do you still see gains coming through?
Yes, especially because of the U.S. fiscal stimulus. The bipartisan deal reached earlier in June showed that about half of what was previously announced will getting passed in terms of infrastructure spending. And I think this is what is currently priced in the market. But we're still like half of the way through what Biden's administration has first announced, which is $2 trillion. So I think we might see another bill before the end of the year that could also bring a little bit more stimulus for the economy and therefore for the stock market. And also looking at what happened in Europe, especially looking at all the private spending and the private investment that was triggered by the Juncker plan in 2015 to 2020. I think also bulk of private investment will release fresh impetus for the U.S. infrastructure market. So all the companies exposed to construction, engineering, but also like more next generation infrastructure, broadband infrastructure, and clean technology, renewable energy. So lots of, I think we can see more optimism coming from this fiscal plan.
Okay, so a focus on the fiscal spending, a focus on infrastructure. What about oil prices as one of the drivers of inflationary concerns, Morgane? And I'm thinking about oil prices a lot today, obviously, because OPEC Plus have failed to come to an agreement around what they're going to do about their production levels. And that leaves the threat hanging over markets that we don't see an increase in production, and that $76 a barrel on Brent could head up towards $100. I mean, what's your expectation on oil, Morgane?
Well, the oil prices could just continue to rise because of this absence of increase in production. But at the same time, we see a slowdown in China and in terms of new orders. So we might see for some short period of time, maybe the next few months, not too much of an increase in oil prices. I think that the risk is more over the medium term and the end of the year when we get a clearer picture in the US and see if the economy is just getting a really strong momentum and then could trigger more demand and therefore more need for oil that will push oil prices higher. At the same time, looking at inflationary pressure, I'm less concerned about oil prices. I'm more concerned about supply chain disruptions that could just be aggravated by the rise of new Delta variant cases, especially in Southeast Asia, and then therefore push some input to strong input prices and could much higher again demand.
Okay, we'll keep an eye on that then. Morgane, stay with us. Morgane Deladon, Global X ETF's Director of Research. Thanks for your thoughts so far. Just a bit of breaking news coming through on the Bloomberg, a red headline across the Bloomberg telling me about Turkish inflation. The Turkey June inflation coming in at 17.53%. The estimate was 16.8. We saw a knee-jerk strengthening of the currency and then another weakening of the currency quickly followed. So a sort of a knee-jerk reaction and then a response to that. So we're kind of flat, all told, in terms of our response to that. In terms of the Morrison share price, let's just get to that because this is a big focus for this morning. The bid battle for Morrison's now continues. We've got a group of investors, private equity investors over the weekend declaring their hand, agreeing they thought a deal. And now we see the share price up by 11.5% after we heard from Apollo. They are also considering making an offer for this UK retailer. And so the stock is up by, as I say, 11.5% right now. Coming up on this programme, Germany rejects French calls for a permanent EU debt mechanism to boost investment. We'll assess the outlook for the European recovery. That conversation coming up next. We'll be back to talk about that M&A story as well. This is Bloomberg.
need to be cautious about the Delta variant.
We are still in crisis. We have India is still in massive problems. The entire South America is in big turmoil. The Southeast Asia, excluding China, has not vaccinated, and they have started only a few days ago.
The crisis is not behind us. It's just that the fundamental drivers of recovery are there. The unprecedented amount of fiscal stimulus, the unprecedented amount of monetary stimulus, the very strong good surprises about how the productive machinery of developed economies have been preserved during that crisis.
The point is now to have the most people being vaccinated in the less time possible and to ensure that we have a close monitoring of the circulation of the variant.
I'm extremely optimistic. I mean, the combination again of growth, fundamental growth, vaccinations are very positive trends that should encourage us to see in a very positive way the months ahead of us.
In terms of economic recovery, I'm not anticipating anything happening before second semester 2022.
Business leaders speaking at the Aix-en-Provence Economic Conference on the global recovery. Morgane Deladon, Global X ETF Director of Research, is still with us. And we heard there some views around the global recovery, Morgane, some of those talking specifically about the Delta variant and the risks. What's the next narrative, do you think, as far as the market is concerned, when it comes to the spread of coronavirus and where things head next? Is this going to turn into a story in the autumn, in the fall, around under-vaccinated populations in Europe, in developed markets, and where the risks lie there? Or will this turn into a narrative that enables us to dissect emerging markets into countries that have and have not vaccinated sufficiently? Where does this go next?
I think you're absolutely right. The next narrative will be around which emerging markets will do great, because vaccination rate is the most determinant factor when it comes to the recovery this time around. It's said that about half of the population needs to be vaccinated in order to not to be too vulnerable to new variant strains. So that's will be probably most of the case in the developed world, but in the emerging markets, then there will be a higher differentiation, and also the efficiency of the Chinese vaccines compared to other vaccines will also come into doubt. So again, vaccination rates will be decisive for the recovery in the EM, and will explain, I think, most of the divergence within EM countries.
So that's one of the emerging market themes to watch. I wonder, Morgane, if we also need to keep an eye on geopolitical tension between China and parts of the West, because we see today that Chinese leaders and European leaders are going to be involved in some kind of conference call together. The agenda apparently as yet not finalized. We also see these stories around Didi and the way the Chinese are clamping down on tech companies domestically, but in particular tech companies or companies that have US listings. Is this going to be something that also we're watching more and more in the second half of this year?
We might see more geopolitical tensions, and not only on cybersecurity theme, but also on other themes. And this is, if we want to sum this up, it's also because of the green agenda of most developed countries now, and the demand for certain rare earth materials, but also coppers and semiconductors. Most of these materials, basic materials, are produced in China, and the current supply from developed markets is really dependent on China. So obviously, with this race to a greener economy in the US, in Europe, and in most developed countries, we will definitely see some tensions on how to construct a sustainable supply of new commodities such as cobalt, lithium, and as I mentioned before, more rare earth materials that are becoming in shortages.
So there might be some risks surrounding Chinese technology businesses. What about other areas of tech, Morgane? I understand that fintech is something that you like. How do you distinguish between the fintech names that you want to be involved with and those that are less interesting at this point? Because there's still a lot of them.
Absolutely. So fintech is, I think, a massive theme right now because of its cyclical component with its exposure to financials, but also to tech companies. And you were mentioning China, and the fintech in China among most emerging markets is a very interesting theme because in emerging markets, you don't have to exit an old business models with bank branches, credit cards, for example, and with the rise of smartphones and mobile payments, especially in China, where it is 7 times higher than in the US in terms of mobile payments, we definitely see these themes might be adopted quicker in these regions compared to developed markets. So it's a very interesting theme, and is also reflecting a change in consumer behaviors that has been spurred with the pandemic. Switch to more digital solutions.
Yes, indeed. Changes gaining pace, perhaps. Morgane Deldon, Global X ETFs Director of Research. Thanks very much for joining us. And Morgane will be continuing her conversation with us on Bloomberg Radio at 9 a.m. UK time. Let's take a look at some of the stocks that are on the move then this morning. And Morrison's the subject of what looks increasingly like a bidding war. It might have gone higher even if we hadn't heard from Apollo this morning. But we've heard Fortress, a consortium of bidders led by Fortress, made an offer over the weekend. They thought they had this signed and sealed. They thought they'd done that deal. But then Apollo say this morning that they are evaluating whether they want to make an offer. What does this tell us about the UK market's ability to correctly value these businesses? We see bond markets also on the move in response to this, perhaps a concern that private equity bidders and a bidding war might push up the level of debt, the level of gearing on the balance sheet at this retailer. Let's go to Prosus as well, because we've talked a bit about the Didi story emanating out of China. And if you read this as just another sign that China wants to clamp down on tech giants, then perhaps you become nervous about Tencent. And of course, we know that Prosus has a large shareholding in Tencent, and so that stock down by just over 3%. Let's get a reading on the basic resources space as well. On the GMM function earlier on, we were seeing how some of those names some of those commodities were moving higher this morning. And so we've seen a bit of a burst of a move to the upside from some of the names in the mining space. Off earlier highs, though, that Rio share price was up by more than that. And I've got the BHP and the Anglo and the Antofagasta share prices in front of me, and all of those off earlier highs, but they are in positive territory. Let's get a Bloomberg Business Flash then. Here's Laura Wright. Laura.
Thanks, Anna. SoftBank shares have tumbled after Chinese regulators ordered app stores to remove ride-hailing service Didi. Japan's SoftBank is the top shareholder in Didi, which recently listed in the US. The ban comes just 2 days after China's cyberspace regulator announced a review of Didi. Syngenta is seeking to raise about $10 billion in a Shanghai listing, which could become the world's biggest IPO of the year. The Swiss seed and fertilizer business owned by ChemChina is aiming to list on Shanghai's Nasdaq-style Starboard, with plans to sell a 20% stake in the company. Syngenta was acquired by ChemChina for $43 billion in 2017 in China's biggest foreign takeover to date. Shares in Sydney Airport soared after a $17 billion US takeover offer from a group including IFM investors in one of the boldest bets on a recovery for global travel. The consortium's offer for Australia's largest airport is at a 42% premium to the previous closing price, though still below the level it traded before the pandemic. That's the Bloomberg Business Flash. Anna.
Laura, thank you very much. Laura Wright here in London. Coming up on the programme, our analysts have identified 10 companies to watch going into the second half of the year, and they all have something in common. We'll bring you the details next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It will take some years to spend the 750 billion euro that we have attributed to the member states, and I think it would perhaps we have an academic debate about it that is of course justified and that will always happen. But I think we should not concentrate on the over next step before the next step is implemented. And this is the point. We have not concentrated on ideology. We have not concentrated on what divides us, but we have found common ground by providing solidarity for our member states.
That was the German economy minister, Peter Altmaier, there, pouring cold water on a French proposal to give the European Union a lasting tool, a permanent tool, to raise joint debt. Now, analysts at Bloomberg Intelligence have identified 10 companies where they hold a different view of fundamentals to current market expectations. The stocks range from healthcare to consumer goods and financials. They all have something in common. They each have timely triggers in the coming months. Let's talk now to Tim Craighead, Senior European Equity Strategist for Bloomberg Intelligence. Tim, very good to speak to you. So that's what they all have in common then. They all have a catalyst that could be fast approaching, do they?
Indeed, that's the key. You know, we have a group of ideas across the globe called focus ideas, and these 10 are particularly timely, particularly notable, where we have a differentiated view, but as you said, catalyst ahead that, you know, they could be corporate actions, they could be earnings, they could be a new product, etc. Some are positive, some are negative.
What is the sort of nature of these trades? Are they all pegged to the reopening story, or is there a mix?
Yeah, about half of the 10 are oriented towards the reopening. You know, the most notable instance of that is probably Pfizer. We all know that vaccines are key to the reopening. Pfizer is key to vaccines, but we do think that the market's underappreciating the opportunity for orders on booster vaccines. But, you know, you can also look the other way. We think expectations are too high for Airbus deliveries. There's too much excitement about reopening. And the same is true for DoorDash, which is a U.S. food delivery company that we think could fall prey to people being back in restaurants. Or one of the more interesting ones is Boston Beer. This is Sam Adams. You might be familiar.
Heard of, yeah.
But they also have this hard seltzer. You know, we think of cider in the States, it's seltzer. People have been drinking it at home. We don't think they're going to drink it in restaurants.
Right.
So.
Okay. Appropriate to mention that kind of thing on the 4th of July, 5th of July, as it is.
Indeed.
Late celebration. So that's one of the themes. The reopening trade is one of the themes. But there are other things running through this, are there?
Yeah, no doubt. New managements taking action quite often, you know, can be a really interesting opportunity from, you know, the equity market's perspective. Standard Life Aberdeen is an example where we think restructuring still isn't fully appreciated by investors. UniCredit. There's a lot of fear and trepidation about a Monte Paschi acquisition, but their new CEO has done interesting things in the past from the standpoint of deals. We think that could be a positive catalyst. And there's new products as a different theme. Qualcomm is in the, you know, in the midst of the 5G rollout that we're all at some point going to be part of. And Xpeng is an EV electric vehicle story in China that's quite interesting.
Tell me about these focus ideas then. You've mentioned this in passing, Tim. What are these?
Yeah, so these are high conviction situations where our analysts around the globe really do feel that they've got a differentiated view. But it's not just a potential value trap or something. They've got to have catalysts as well that they think can change market perception towards what we think is fundamentally going to happen. And all of these are on the terminal. They can be found at BI Focus, for example. And, you know, we did do an interesting little JV, I suppose, with Bloomberg Business Week. And that's where these 10 companies to watch can be found.
Absolutely. And I saw that, and I saw all the graphics that went with it. Thanks very much, Tim. Thanks for bringing us the insights. Tim Craighead, Senior European Equity Strategist for Bloomberg Intelligence. And Tim was just mentioning Standard Life Aberdeen, which is interesting because we're going to be sticking with one of the companies, and that is the one that could see positive triggers, according to Bloomberg Intelligence. That is Standard Life Aberdeen, today rebranding as, now I'm told to say this as Aberdeen, but when you see it written down, it's ABRDN. We speak to the CEO, Stephen Bird. He's joining us next. Note, no capital letters. They are apparently very last millennium. We will talk to Stephen shortly. This is Bloomberg.
Morning was a bit of a historic day. It was the first time Indigenous designers showcased at Australian Fashion Week, and it was a full house of all Indigenous talent.
It made me so proud. Absolutely beautifully done. I mean, the designers, the pieces on there, I think just about every model or every second model was like, oh, I want that, I want that. So each of my pieces, we have our signature prints, which are each tell a story and is definitely a contemporary way of experiencing Aboriginal culture. And then each of my pieces are named after, inspiring Aboriginal and Torres Strait Islander women. So when the customer buys something, they're learning about the story, they're learning about women. I would hope that it isn't tokenistic, and I would hope that it's not done to tick a box. And so, you know, those things have to be, you have to be mindful about that. But yeah, I think it's incredible what's been achieved so far, but, you know, there's always room for growth. I think the elevation of Aboriginal and Torres Strait Islander people in these spaces, it's long overdue, and it's a really powerful and incredible time, I think, and to be a part of that is really special.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into our European trading day, and we could be light volume today. We are without the United States, of course, because it is July the 5th, celebrating July the 4th, so it's a market holiday stateside. We have European equity markets just drifting to the downside a little, the FTSE 100 fairly flat, but elsewhere we see bigger moves. Let's check the sector picture for you and see whether we've got any interesting stories developing there. Only a few sectors in positive territory. Basic resources, one of those. As I mentioned earlier, though, we're off our earlier highs, but we had been pushing higher on those basic resource stocks as we saw iron ore and other metals prices moving to the upside. Autos and parts a little bit weaker. Interesting, we had that interview with the Michelin boss, and he was talking about ongoing supply chain concerns there, but we do see broadly that sector under pressure. Now, one storied brand in UK finance has a new name. As of today, Standard Life Aberdeen is calling itself Aberdeen. That's Aberdeen without, well, any of the E's. It's spelled A-B, well, we'll show you at the bottom of the screen, and then you'll see, there we go, A-B-R-D-N. And the name symbolizes, according to the business, clarity of focus and a renewed sense of purpose. Joining us now is Stephen Bird, Aberdeen's CEO. Stephen, thank you very much for joining us. It's easy to see on paper, a little harder to read, as I just demonstrated. You're referring to it as Aberdeen. What's prompted this decision?
Well, as you just demonstrated, Anna, it's also very easy to say, and our name, Aberdeen, is well known all throughout the world, throughout Asia, throughout Europe and the US. In fact, it has been given a huge welcome there. We were Standard Life Aberdeen, which was a brand name that advertised two companies coming together. We are a single team, Aberdeen, focused on delivering for our clients. This change of our brand today to Aberdeen PLC is a very important milestone, but as your previous guest just said, it's just one milestone that demonstrates the simplification and growth of this business. Now we have, you reported last week that we had divested of HDFC Life in India. We received the proceeds of the divestment of Promenian last week. We are focused on our clients, and that has meant refocusing the group and bringing the whole team together under a single brand. We have got a phenomenal group of investors, and having them focused on clients, not worried about whether they came from Standard Life or Aberdeen, is really why we've done this.
Okay, but why not just call it Aberdeen then? I mean, if you're just going to remove some of the E's and not capitalize anything, why not just call it Aberdeen with a capital A and reinstate the E's? And that would make it maybe easier to say. Does the marketing show that this goes down well with a younger audience, or is that the target for this?
Well, of course, I mean, I'm sure you're aware that Aberdeen is a city in the north of Scotland. It's also a football club. It's also a university. ABRDN is a unique, ownable asset. Aberdeen, which is easy to say and easy to search for, aberdeen.com, aberdeen.co.uk. We now own the rights to Aberdeen, as you can see on the screen today, all over the world. The 21st century is composed of platform businesses that use data to invest wisely, that use digital connectivity to reach clients. You know, we've gone live, reaching wholesale clients by connecting through APIs into the bank platforms. ABRDN is a new form of Aberdeen. Aberdeen was a great company. It's a legacy company, much smaller than we are. We've got the combined benefits of all the investors of Standard Life and of Aberdeen. The reason the deal was done originally, predates me, was to bring best of breed, fund managers, funds, technologies, clients, global reach. But having Standard Life Aberdeen and having both sides wondering who was dominant, we are a single team focused on clients, and Aberdeen does that very successfully. Our clients love it.
Okay, so that's the story behind the name. I wonder what this means, though, for the business going forward then, Stephen. You've given us some sense of that. You've talked about wanting to grow in Asia and in the UK. Can you give us, now we move on from the name, can you give us any specifics about what that means?
Yes, I shared in March our strategy, our 3-year growth strategy, which is not an overnight thing. And the strategy is to, in the global investment manager, is to grow in Asia and grow in private markets. And you know, we have a new chief executive. He's now 3 or 4 months into his role in Asia, making fantastic progress. That's Rennie Bullman. And in private markets, you saw that we acquired a business called Tritax. So Tritax are Amazon's largest landlord. That's an example of where we invest in investment excellence, because that's what our clients want us to do. Now, turning to the UK is a compelling opportunity. We are the #1 platform in the UK, Wrap and Elevate. 51% of the UK independent financial advisors use our platforms, and we have upgraded that tech stack. So coming in the fall is the new version of Wrap and of Elevate, which makes an independent financial advisor's life easier. It helps answer the toughest questions that clients have about, am I investing at the right rate? Am I investing in the right things? What are the tax implications for me going forward? These are the questions which UK adults need answers to, and our technology provides those answers. And so we're very, very focused. That's a high growth business. I mean, your previous, Tim talked about us being recognized the restructuring. The restructuring, just think about it. 3 vectors of growth: global investment manager, UK advisor, UK savings and wealth, and the personal business. All of that uses our technology to deliver great outcomes for clients. Clients are interested in delivering outcomes.
And in terms of that restructuring then, Stephen, you've had a reputation in other roles for cost cutting. Is that going to be part of what happens at Aberdeen?
Well, that's why we made huge progress in the last 8 months. We sold some businesses that were subscale in the Nordics. We sold Parmenion. In fact, we got the proceeds for it last week. We successfully divested of HDFC Life in India. All of that has actually strengthened our financial position. And the strategy that I explained, which is well underway, we're 8 months into pursuing this 3-vector model, and the energy in the business is palpable. I got messages last night, people so excited. I got a message saying, I've been 18 years in this company. I've never felt the sense of energy and cohesion that I feel today. That's why it's so exciting to be Aberdeen PLC.
Okay, and what about hiring? What about growth? What are the skills that you're lacking, Stephen, that you're looking for?
Well, we've done quite a lot of hiring. We've got a lot of people wanting to join this mission. So I mentioned new Chief Executive Rennie Bowman in Asia. We hired Caroline Connellan to run the personal business. Caroline was the CEO at Brooks Macdonald in the UK, and she chose to join this team because she believes this mission is a phenomenal one and that we've got great capabilities in our platform. Today, we also have a new people director, Tracy Hunt, fantastic person with high EQ and IQ, because this is a people business. We are an active asset manager at a time where active asset management is critically important. This is a great time to be a selective and informed investor. We are seeing differential rates of growth throughout the world, differential values throughout the world. We're seeing the vaccine leaders and the laggards. We've seen the US market grind higher, up to 23 times multiple, but we see relatively better value in the UK. That's why you've been reporting a lot of PE money coming into the UK. We're seeing Europe relatively slower, but now accelerating in vaccines, also representing value. So our clients want to know what happens next. We're futurists, and we are people that explain and outline where you should be invested in order to be able to meet your investment outcomes. And that's what we're doing.
And passive funds, they're increasingly part of that, are they? Just how big can they become for Aberdeen?
Well, we launched 2 tax-efficient passive funds for our largest client, Phoenix. We're now extending them beyond Phoenix. Passive has an important role, but not only passive, and ETFs, really thematic ETFs. ETFs for us are a delivery mechanism. If you just think about what it does, you can have an idea and deliver that. It can be an active idea, it can be a thematic, but you can deliver it in a very efficient mechanism. Daily pricing, low cost for our clients, and that's what clients want. So that is part of our strategy as we invest in technology. And I didn't mention, we are now running on a single investments platform. The underappreciation of the restructuring that Tim mentioned, your prior guest, is because this team is executing at pace. If you think of what we've been able to do during the pandemic, to be able to divest of non-core businesses, acquire excellent businesses, implement a three-vector growth model, resolve the branding of Standard Life Aberdeen, and in so doing, extend our largest client, Phoenix, all the way to 2031, and embrace a brand that is a digital brand, a brand that really embodies the courage, the conviction, and the optimism that good investors need. And that's what we are today.
Stephen, thank you so much for joining us. Stephen Bird, the Aberdeen CEO. You see, you say it Aberdeen, it's written A-B-R-D-N. That's the new way of things. Thanks very much to Stephen for joining us. Good to get his perspective. Good to get the story. Let's get a Bloomberg First Word News update. Here's Laura Wright with that. Laura.
Thanks, Anna. President Biden has celebrated what he called a heroic U.S. vaccination campaign in a speech on the July 4th holiday. Biden declared the U.S. had achieved independence from the coronavirus, though he cautioned against complacency as more transmissible variants circulate.
Never again want to be where we were a year ago today. So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives, it no longer paralyzes our nation, and it's within our power to make sure it never does again.
Boris Johnson will urge Britons to exercise judgment to protect themselves from COVID after the final unlocking of the economy in 2 weeks. The UK Prime Minister will set out the last stage of his roadmap out of lockdown for England at a press conference later today. The country is seeing soaring transmission of the Delta variant, but so far without high levels of hospitalizations. Cybersecurity researchers say the hackers behind the latest mass ransomware attack exploited a vulnerability in management software made by Kaseya. The hack has hit at least 20 IT service providers and more than 1,000 businesses. Russia-linked Revil has been accused of launching the attack, the same group which was thought to be behind May's JBS hack. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Coming up on the programme, over a barrel, the oil market standoff between Saudi Arabia and the UAE continues. We'll bring you interviews with the energy ministers from both countries next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Welcome back to the European Market Open. 45 minutes into our first trading day of the week. We're without the United States, of course, a public holiday over in the US. We've got European equity markets trading to the downside, down 0.3% this hour. Now, the standoff between Saudi Arabia and the UAE is deepening. A rare spat between the longtime OPEC allies has left oil markets in limbo and the global economy guessing how much oil it will receive next month. Abu Dhabi says it won't accept a plan to extend the output curbs beyond April 2022 unless it's given better terms, while the Saudis say they won't give in to those demands. Manus Krani spoke to the UAE Energy Minister Suhail Al-Mazroui, and Anne-Marie Hordern spoke exclusively to his Saudi counterpart.
I would emphasize that it is the whole group versus one country. Which is sad to me, but this is the reality today.
And how concerned are you if there is no agreement and potentially we could see what we saw last year, which becomes a price war?
We have an existing agreement, Mary. I keep reminding people, unlike what you had in March, we have an existing agreement. We will honor that agreement. We'll continue with it. The agreement requires that we bring more production, yes, but to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend. Again, the extension put lots of people in their comfort zone. It brings volumes to address the short term, but it also addresses for the market. Check with all those who are participants in this market. Tell them.
The current agreement, if not extended, has no production increase for August. So if not every member signs up tomorrow, what happens in August?
Well, it's your chance to have another maybe interview with me tomorrow or after tomorrow. It depends on how we will finish.
Are you worried we could see a massive spike in prices because the market is in need of more supply for the month of August?
If some people would like to have that, they can do that. Is it our intent? No. Because if it is our intent, why would we do the proposal? And why we would work with our colleagues? It's been a 2-month affair.
If you're on board with the proposal, Russia and the rest of OPEC is, and there's just one holdout, and that's the UAE, will you continue to increase by 400,000 barrels a day without the UAE on board?
We cannot. Because it's an agreement that is done by consensus.
The reality is that UAE is for an unconditional increase of production, which the market would require. And that's, I think, the agreement that all of the countries are supportive with. There has been a proposed level of production by the GMMC, and we are for that. We have done that in the past, where that production increase or adjustment was unconditional. This time, the GMMC brought a condition to that production increase. And to us, that condition is one, unnecessary to take now. We still have 8 to 9 months in this agreement. And we're talking about a plenty of time for this agreement to discuss and come up at a later stage with the conditions of the extension. Agreeing on what the market would require now is the priority, and we are for that. So I think that's where we differ from the GMMC. The GMMC brought one option only, and they asked all of the member countries to vote on it. And all of the countries have voted for it because they have They have a different situation when it comes to the baseline than us in UAE. We believe we have a special situation that we need to be given time to explain it to the to our friends.
Okay, so Minister, just 1 second. So you are unconditional in your acceptance of the increase in production. You are requesting a raise in the baseline. The only way to compromise forward is what? A raise in your baseline of production. Is that how you see the situation right now?
No, what we are requiring is to delay, to decouple the two decisions, delay the extension decision to a later time where time is given for UAE to present its case to an independent or to the Secretariat, where we compare our status with the rest of the group. We are only asking for a fair treatment. UAE have lost 1/3 of its production capacity. It's sitting idle, while many other countries have been given a level production more than their capacity to produce. So that is totally unfair and unsustainable.
The Saudi and UAE energy ministers there speaking to Bloomberg. Coming up on this program, we'll dig into what's moving the markets, including that OPEC spat, the FOMC minutes due this week. We'll talk through the Markets Live team next. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. European equity markets then 54 minutes into their trading session, moving to the downside, down 0.3%. We just got the French June services PMI 57.8, almost in line, a little bit better than the prelim number of 57.4. Let's talk to Laura Cooper from our Markets Live team. It's a little quiet out there, perhaps. A lot of news to think about today when it comes to geopolitics, when it comes to the oil market, certainly, Laura, but we are without the US. The oil story, though, that could keep us on our toes.
Well, certainly, and that's as we are seeing just this deadlock extend with OPEC plus. And I think what's surprising is the fact that oil prices are remaining relatively range-bound. Now, that could change quite quickly if we do see this tail risk of a no-deal outcome materialize, because as we look through the third quarter, we are expecting to see an oil market that is increasingly in deficit. So we do need that supply to come on the market. So that does potentially risk a price spike should we not see any kind of agreement in the coming days.
We just got the German June services PMI, so I'll just bring that one to everybody's attention as well. A little bit weaker than the prelim, but still very much in expansion territory, 57.5. The prelim, 58.1. What's your focus for the week then, Laura? Is it going to be on the minutes from the Fed, or have we had so much explanation from Fed officials since we had that June meeting that we wonder what new we're going to learn from those minutes?
Well, I do think the FOMC meeting minutes are really the highlight for the week, and that's because we want to kind of parse through what more details are around, the shift that we saw. So when we looked at the market expectations around that dot plots, we did have 7 members increase their 2022 hike relative to 4 previously. But what was interesting in the FOMC meeting was the fact that the emphasis on the labor market recovery, we have not yet seen that come through in the payrolls numbers. So it'd be interesting to see how the Fed is actually gauging that substantial further progress in order to kind of get any hints on that tapering timeline.
Okay, Laura, thanks very much. Laura Cooper, have a good week from our Markets Live team. That is it for the European Market Open. Surveillance Early Edition is up next. Remember, of course, US markets closed today. No cash trading for equity markets. We do have US equity futures open, and they do point to the downside by around 0.2%. That sort of goes hand in hand with the weakness we're seeing across European equity markets this morning. It was the 4th of July yesterday, so that is why we have no US trading today. Surveillance Early Edition is up next. This is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
They've never brought that complaint before, even after signing, immediately or before signing the April agreement.
We sacrificed a lot. We will continue to sacrifice until the end of this agreement. That's our commitment.
But to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend.
But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
This is Bloomberg Surveillance, Early Edition with Francine Lacroix.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition on this Monday, the 5th of July. I'm Francine Lacroix here in London, and here's what's coming up on today's program. OPEC breakdown. The UAE blocks the cartel's output decision, claiming that there is no need to extend production cuts to next year. Saudi Arabia insists that the extension must happen. China's tech crackdown continues. Beijing removes Didi from app stores as it widens its cybersecurity review. 3 other online platforms are now in the firing line. And stay tuned with the Early Edition. We'll discuss today's big themes with the Goldman Sachs head of commodities, Jeff Curry, and economist and author Dambisa Moyo. So there's a crisis in OPEC Plus as Saudi Arabia pushes back against the UAE's opposition to a proposed production increase. In an unprecedented move, both countries have aired their grievances on television. First, let's hear from the UAE Energy Minister Sohail Al-Mazroui.
And just to be clear then, sir, you've not threatened to leave OPEC, and right now you're not prepared to threaten to leave if you don't get a deal.
No, I think if we don't get a deal, then we have an agreement to fulfill. We are not now close even to elapsing that agreement. We are not threatening to walk away from the agreement. We're not threatening. We haven't threatened anyone. UAE is not going to be an obstacle in front of anyone. But we are not going to threaten. That is not our strategy. We have been sacrificed. We sacrificed a lot. We will continue to sacrifice until the end of this agreement. That's our commitment. But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
Well, Saudi Arabia's energy minister, Prince Abdulaziz bin Salman, also spoke exclusively with Bloomberg's Anne-Marie Hordern.
I would emphasize that it is the whole group versus one country, which is sad to me, but this is the reality today.
And how concerned are you if there is no agreement and potentially we could see what we saw last year, which becomes a price war?
We have an existing agreement, Mary. I keep reminding people, unlike what you had in March, we have an existing agreement. We will honor that agreement. We'll continue with it. The agreement requires that we bring more production, yes, but to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend. Again, the extension put lots of people in their comfort zone. It brings volumes to address the short term, but it also addresses for the market. Check with all those who are participant in this market. Tell them.
The current agreement, if not extended, has no production increase for August. So if not every member signs up tomorrow, what happens in August?
Well, it's your chance to have another maybe interview with me tomorrow or after tomorrow. It depends on how we will finish.
Are you worried we could see a massive spike in prices because the market is in need of more supply for the month of August?
If some people would like to have that, they can do that. Is it our intent? No. Because if it is our intent, why would we do the proposal? And why we would work with our colleagues? It's been a 2-month affair.
If you're on board with the proposal, Russia and the rest of OPEC is, and there's just one holdout, and that's the UAE. Will you continue to increase by 400,000 barrels a day without the UAE on board?
We cannot. Because it's an agreement that is done by consensus.
Our exclusive there with the Saudi Energy Minister Prince Abdulaziz bin Salman on the spat driving OPEC Plus. Now, coming up later in the program, we'll also be speaking with Jeff Curry. He's Global Head of Commodities Research at Goldman Sachs to get his view on what the row could actually mean for oil markets. For the moment, it's quite a lot of drama, and it's also driving the price of oil. Don't miss that conversation. Now, joining us now is Peter Kinsella. He's a Global Head of FX Strategy at Union Bancaire Privée. Peter, as always, thank you so much for joining us. There is actually so much drama surrounding OPEC Plus and the possible price of oil. Does that translate into maybe what you would do for FX that's tied to oil?
Basically, if you look at money,
I think we're just having a couple of difficulties. I don't know whether it's me that can't hear Peter or whether everyone can also hear him with a very loud echo. We'll get back to Peter shortly. Peter Kinsella, Global Head of FX Strategy at Union Bancaire Privée. Now, coming up, we also look at China. We also look at tech. China's tech crackdown continues. Beijing has banned ride-hailing giant Didi from app stores days after its U.S. IPO. And then a little bit later, we were just talking about it with Peter Kinsella. We talk more about OPEC Plus and the crisis. The standoff between Saudi Arabia and the UAE leaves oil markets in a limbo. We'll speak with Jeff Curry shortly. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Chinese President Xi Jinping, German Chancellor Angela Merkel and France's Emmanuel Macron are expected to hold a video call this week. The meeting comes as tensions simmer between Europe and the world's second largest economy over human rights and democracy issues. Now, President Biden has celebrated what he called a heroic U.S. vaccination campaign in a speech on the 4th of the July holiday. Biden declared the U.S. had achieved independence from the coronavirus, though he cautioned against complacency as more transmissible variants do circulate.
We never again want to be where we were a year ago today. So today, while the virus hasn't been vanquished, we know this: it no longer controls our lives, it no longer paralyzes our nation, and it's within our power to make sure it never does again.
Here in the UK, Boris Johnson will urge Britons to exercise judgment to protect themselves from COVID after the final unlocking of the economy in 2 weeks' time. The Prime Minister will set out the last stage of his roadmap of lockdown for England at a press conference happening later today. The country is seeing soaring transmission of the Delta variant, but so far without high levels of hospitalizations. And German Finance Minister Olaf Scholz says countries holding out against a global corporate tax deal will eventually come around because of the widespread support it has been receiving. Ireland, Hungary and Estonia are among those currently refusing to back that plan.
130 states agreed. They are more than 90% of world GDP, so this is something. And on the other hand, I know that even in the past, many countries that were not supporting the proposals right from the beginning later supported them. There is a big train now on the track, and I think it will continue to go to its aim.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Now, coming up, we'll be speaking with Jeff Curry, Global Head of Commodities Research at Goldman Sachs, to get his views on what the row at OPEC could mean for oil markets. If you have any questions, and I know you do, feel free to write in IB Plus TV Go. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. I don't think we have Leanne, actually. Let me read you the first words, and then we'll have plenty more, of course, on everything that's going on with OPEC. Now, raw material prices surge in the wake of pandemic and disrupt the supply chain. European companies are pushing up prices. That's what industry bosses told Bloomberg's Caroline Conant at the Aix-en-Provence Economic Conference over the weekend. Here they are.
We see some shortages when the economy is catching up, exiting from the crisis on a worldwide basis, and we have shortages of boats, containers, some raw materials, and the entire upstream supply chain has been disturbed. The impact for us is we see our input costs rising, but fortunately the Michelin brand is very strong and we are able to pass it to our customers.
So the consumers, the customers will end up paying the price?
Yes. At the end, it's always the customer that pays the price.
So how much does that represent in terms of increase of price for the customers?
It's we have risen our prices twice already, once early March and the second time in early July. It's around 6 to 8% cumulative.
More generally, what's the impact of inflation on the transport sector?
Let me give you an example. The price of a container shipped from Singapore to US was pre-COVID in 2019, end of 2019, at $2,400. Now it's at $9,800.
So you're expecting a 2023 recovery. Do you think the Delta variant could derail this forecast?
Of course, but the world is, everybody is anticipating that we are already on the exit, and I'm still saying we are still in crisis. We have India is still in massive problems. The entire South America is in big turmoil. The Southeast Asia, excluding China, has not vaccinated, and they have started only a few days ago, and therefore the economy is not yet back to its normal level. So the Delta may have an impact, may slow down the recovery in Europe and in the US, but I trust that we will be able to vaccinate more people, and therefore we should exit this. But in terms of economic recovery, I'm not anticipating anything happening before second semester 2022.
That was the Michelin Chief Executive Officer speaking exclusively to Bloomberg's Caroline Conant in Aix-en-Provence. You could almost hear the cicadas in that beautiful background. Now, joining us to talk about FX is Peter Kinsella, third time lucky Peter, Global Head of FX Strategy at Union Bancaire Privée. I hope you can hear me. I can hear you. We're in good shape. Talk to me a little bit about some of the currencies that are linked to oil. How much do they, how volatile will they be actually until we get an agreement or until it's dead in the water?
Okay. Nice to speak with you, Francine. I think if we look at oil currencies, so if you look at sort of, the ruble, you look at Norwegian krona, and certainly the Canadian dollar, in recent days have weakened somewhat just ahead of this meeting. That's surprising in a sense, because if we look at how these currencies are trading relative to oil, they do appear to be trading very, very cheaply. In particular, the ruble, it's trading way below levels that we would sort of consider, to be highly correlated with Russia in terms of trade. Similar story with the Canadian dollar. The current oil price is $75 a barrel. It's kind of consistent with dollar CAD trading below 120. So certainly, I think that the main oil producers do appear to be trading, very, very cheap relative to their terms of trade, and that does suggest, that there will be definitely a catch-up trade if we do see OPEC come towards some kind of an agreement in the coming days.
Yeah, I know you sent a chart, Peter, and we love that actually guests come with charts. I mean, it's actually looking at the terms of trade in the ruble. When you look at trade in general, does it pick up because of the recovery, or is it still uncertain because of the variance?
I think certainly on as regards the recovery, it's basically sort of increasingly both a demand and a supply story, right? So what we see certainly is a return of some consumer demand, and certainly sort of the aviation sector. Likewise, we're seeing this large, I'd say long running decline in global oil inventories. That's all sort of indicative of a return of demand. But we're still looking at a relatively tight supply backdrop, and consequently, I think that, in my view at least, it will lead to sort of an increase in prices over the short term. And it does seem as though oil is pretty well supported. We've gone from this trading range of sort of $35 to $50 a barrel, and now we're kind of somewhere between 55 and 75. We may even crack that a little bit higher. So, overall, I do think that's consistent with an appreciation story for these currencies.
Peter, thank you so much for joining us. Peter Kinsella, the Global Head of FX Strategy at Union Bancaire Privée. Now, for more on OPEC and all things oil, I'm delighted to be joined by Jeff Curry. He's Global Head of Commodities at Goldman Sachs. Jeff, as always, thank you for joining us, especially on a day where we see so much drama with oil. How will this be resolved?
Well, let's look at the two oppositions on both sides. You have UAE on one side. They want a higher baseline to better reflect the investment they've made in their production capacity. But it's a large number. They want to go up 700,000 barrels per day to something around 3.85 million barrels per day. Now, why is Saudi opposed to that? Because it would change the quotas of many of the other producers, most likely downward, and Russia would be the one that they don't want to actually offend in this process. So when we look at the standoff, the most likely outcome, and the outcome that the market's pricing in right now, is the deal that they proposed last week with no extension past April 22. That then gives time for UAE to argue for a higher baseline. In terms of thinking about their commitment to the deal, the main view here is that both sides remain committed. Which means there's a low probability of this thing unraveling with a large increase in production, similar to what we saw a little over a year ago. So we would view, the risk here more to the upside. But if it did fall apart, it's important to remember that one of the members here is arguing for higher production. But our base case here is we get a deal today. That's what the market's pricing in, and it's probably one where you have no extension past April 22.
But Jeff, I mean, we heard from the Saudi energy minister talking about precedent. I mean, this is a pretty big drama for OPEC Plus. Could this be the dispute that dissolves OPEC Plus?
Well, we look at OPEC Plus, including Russia and the non-OPEC members. It was a temporary three-phase production deal to deal with the drop in demand around the COVID. In terms of thinking about the long-term longevity of it, the core of this really is OPEC. And the dispute we're talking about is within two allies. Yes, it's high-level diplomacy between two allies, but the core of this is OPEC, GCC countries, which are at the center of OPEC, which has been around and will be around long after this current deal that was focused on dealing with COVID.
But so will OPEC stay, Jeff? I mean, I used to cover OPEC like 15, 20 years ago. This feels very personal. It's really two members that won't budge. And, the question is also, why is the market taking it so calmly for now?
Well, I mean, you had a proposal put out last night by UAE that talked about, hey, let's not extend it past April 22, because the deal that was proposed last week was an extension past April 22 to the end of next year. So by throwing out this compromise where you don't extend past April 22, provides more room for negotiation for UAE to be able to establish a higher baseline.
Why did it become so hostile so fast? Why did it escalate? I mean, Saudi Arabia went as far to say as it's, the whole of OPEC against one country.
Oh, well, this has been an issue that UAE has been bringing up now for, going back through the last year or so. Now, in terms of why Saudi Arabia is opposed to it, Saudi Arabia is opposed to it because you have so many other members that they have worked around to create a quota system that is agreed upon. But I think the key point here is that OPEC has always operated around this idea of unanimous consent around any type of arrangement. So in terms of trying to get this last party in line, I think that's part of the reason why they're so aggressive in trying to do this, because ultimately, because you think about what happened with this initial deal, you ended up having to have President Trump at the time get involved to get Mexico across the line. So this whole idea of having unanimous consent, I think, it's a long-standing history within many of these OPEC agreements.
No, you're right. And last year we had a pretty punishing price war between, Russia and Saudi Arabia. But we all know how volatile that was and how that ended up. I know you're pretty confident that there will be some kind of agreement, but could we see a repeat of what we saw last year?
Extremely unlikely. It's not in anybody's interest at this point right now. Demand is very strong. We estimate the market was in a deficit of 2.3 million barrels per day in the month of June. That's the highest level since last summer when we were coming out of that COVID crisis. Demand is surging ahead with the summer travel season. Supply outside of core OPEC is nearly inelastic. So the market environment today is probably the best we've seen in decades. So it's very unlikely that you would see one of these parties jeopardize this opportunity right now by starting a price war. We think the risks are very much skewed to the upside. And let's just remember, all of the production capacity, the spare capacity, mostly exists inside of core OPEC, meaning the GCC countries. This is a very unique situation because you have not seen investment in the shale. Non-OPEC ex-US production is in decline in many parts of the world. So in terms of looking at strong demand on one side, inelastic supply curve outside of core OPEC, very sharp declines in inventories, this is a very unique opportunity for the market. And if you are, sitting in GCC countries right now, you don't want to squander that opportunity. So from a game theory perspective, it's not in their interest.
So, Jeff, where do you see the price of oil going?
Our base case is $80 a barrel during the third quarter, but that means spikes above to the upside above that to average 80. Can it be in the $85 to $90 a barrel range? Particularly before you get to Labor Day, this market's going to be tight given the surge in travel demand that we're seeing, both in terms of air as well as on ground, suggests that demand's going to remain strong. At the same time, there's no supply increases in sight. The drilling in the U.S. shale patch is not sufficient to grow production going into year end. Then you look at the Iranian deal right now. It's difficult to imagine to see Iranian supplies before, let's say October, November at the earliest right now. So this market's going to remain tight during the summer months.
Jeff, if it goes above 90, does it actually, how much does it hurt the world recovery?
The global economy is very strong right now. I like to point this out. You have gasoline at the retail level in the United States in that $4 to $5 a gallon range in different parts of the United States. Have you heard a peep out of people in the U.S. or out of the U.S. president like typically you would see in this environment? The answer is no, which is an indication that the underlying economic environment is relatively strong and allows the system to be able to handle these higher prices.
Jeff, what surprised you the most, and actually how this, how this escalated? I know I keep on going back to, what exactly happened over last week, why it escalated so quickly, and why you're so confident that actually, it won't break down completely.
It just goes down to the fact it's in nobody's interest for a complete breakdown, given how strong the underlying fundamentals are. When you think about the breakdown that happened going back, a little over a year ago, the underlying fundamentals were incredibly weak. So one party had the capability to be able to create a huge decline in prices because it basically used the fundamentals in its, to help, a tailwind to help in creating that downdraft in prices. Today, you're fighting a very tight fundamental picture. Which means if you want to try to make this market go down, you're going to need a lot. Let's just look at it. If you think about the overall deficit is 2.3 million barrels per day. If you just want to get this thing into a surplus right now, you as one producer would need to add more than 2.3 million barrels per day. Going back to a little over a year ago, you didn't need to add much. You just push the market off the cliff. Today, it's a really tight market, and it would be an uphill battle to be able to create that surplus to create a pricing more similar to what we saw a year ago. So it's a very difficult, tall ask to create right now, and it's not in anybody's interest.
Jeff, on commodities in general, and certainly some of the commodities that actually are needed for the energy transition, are we underinvesting? Are we going to have a crisis in 6, 10, 18 months because we're just not investing enough, and so we won't be able to pull some of the stuff out of the ground?
It is shocking how tight every single one of these markets are, whether if it was agriculture with the acreage report that came out last week, or it's the metals markets, lack of greenfield capex, maintenance capex, inventories declining, or it's the power and gas markets in California, Europe, even in China, power and gas markets are tight. So in terms of looking at the overall ability to grow supply, the situation in oil is not unique. The problem exists in agriculture, it exists in metals, and it exists in power and gas. And it's unlikely to change because of in any time in the near future. Many of these companies are focused on return on equity for the first time in, some cases, decades. So if you use the example of what happened in the 2000s, the bull market started 2003, and you didn't see a big increase in oil capex till 2006 and metals capex till 2008. And at this point right now, we've seen a huge run up in prices over the last 12 months. And in terms of looking at big increases in capex and investment, we haven't really seen any.
Jeff, thank you so much, as always, for your wisdom. Jeff,
thank you for having me.
Global Head of Commodities at Goldman Sachs. Now, 3 unlikely EU countries are resisting the global call for revamp of corporate tax. Hungary, Estonia, and Ireland are challenging proposals for a worldwide minimum rate, even as 130 countries backed the deal at last week's OECD talks. Now, this week's G20 meeting may prove crucial to a breakthrough, but Germany's Olaf Scholz says the tax agreement is a matter of when rather than if.
130 states agreed. They are more than 90% of world GDP, so this is something. And on the other hand, I know that even in the past, many countries that were not supporting the proposals right from the beginning later supported them. There is a big train now on the track, and I think it will continue to go to its aim.
And as countries hash out the details of what a global corporate tax might be or might mean, boards and huge multinationals like Google, Facebook, and Amazon will have to add the proposals to their agendas. Well, joining us now to discuss further is Dambisa Moyo, economist and author of How Boards Work and How They Work Better in a Chaotic World. So congratulations again, Dambisa, on the book. There's so many questions that I have on you, from global taxes to, of course, what we're seeing in terms of recovery to some of the things that worry you. Overall, are boards and companies looking at the right things, or is there a worry that there's a black swan out there that they don't see coming, like cyber attack, that could actually put them flat on their feet?
Well, first of all, thank you for having me. I'm delighted to be here. I think what you're asking is a very important question, because ultimately, we can't just focus on tactics in order to run these businesses. We need to think about the more structural long-term challenges. So what do I mean by that? Clearly, in the past 18 months, as we ought to do all the time, we've been thinking about the safety of workers, keeping the proverbial lights on, and making sure that we've got solid balance sheets to race through what was a very tough period, certainly over the last few months. But we also cannot lose sight of the more structural challenges like capital allocation, which we know time and time again will determine the sort of winners from the losers. And that becomes very murky in an environment which is uncertain, not just in the short term, but also in the long term, because of the rise of China, issues such as tax, as you just mentioned, the sort of broader environment around low economic growth prospects, environmental concerns, demographics, inequality, etc. So there are lots of headwinds, but corporations, I think, need to really focus on that long-term proposition just as much as they're thinking about the short term, and that can be very difficult and a delicate balance to hold.
Yeah, and Dambisa, I guess the question is, how much are they thinking about longer term as opposed to short term, given also we're, just in a recovery phase, there's still variants that people are uncertain about, and so it's unclear what corporations need to do.
Yeah, so I think it varies from a company by company basis. I mean, if I can be a bit cheeky about it, I would say we'll know who's been focusing on the long term in another 5 years, because those companies that are actually putting money to work, just picking up on Jeff's comments a moment ago regarding the sort of structural shortages, whether it's in semiconductors or in commodities, companies are going to have to make those types of investments today in order to reap rewards in 5, 10, 15 years. But they're obviously putting your gas mask on now has been really important as companies have tried to figure out how to keep employees working. So I would say the boardrooms in which I sit, we are equally focused on short-term versus long-term, and I hope other companies are doing the same.
What, Dambisa, is the one thing that actually you think we've made progress on in the last 12 to 14 months? I know you've done a lot of work on, minorities. You've done a lot of work on also, for example, the relationship between developed economies and developing economies. Are things getting better for the disadvantaged, or are they actually getting worse?
Well, even before COVID hit in earnest in 2020, we were already worried about low economic growth, the sort of prospects for growth and subsequently, obviously, returns and equities, but also more generally issues of climate change and inequality were already problematic. And add to that levels of debt and sort of the impotence of public policy, both on monetary and fiscal policy. So in that respect, COVID has really accelerated a lot of the trauma that we were expecting and anticipating. If you ask me what have we learned, I mean, clearly, if what I say is right, which I do believe, that we are accelerating some of the challenges that we were anticipating, such as digitization, that's something that we've learned from live by having to have workers deployed around the world in their homes and in different environments. Not just thinking about what the cyber risks, the downside are, but what opportunities they are for work from home going forward. But your question around emerging markets, developing countries, I think is really important because as euphoric and in some sense as Jeff sounded about a recovery, I think that there's still a lack of clarity of when and how emerging market economies, whether it's in South America, Africa, Asia, will come on board, given the sort of issues with variants, but also around vaccine deployment. So I think we're still not clear in terms of timing around that. There's no doubt about it that there's definitely a surge in the US in terms of markets and macro, but I would be more sort of less sanguine, I should say, about the prospects in the next 18 months vis-a-vis emerging markets.
Dambisa, does working from home does it help with productivity across the world? So could it actually be beneficial to certain economies because people are more productive, but does it, again, leave more people behind in developed economies?
Well, there's a wonderful paper that just came out from the University of Chicago, which basically argues, I'm putting it in shorthand, but essentially that there is a reduction in productivity from people working from home. I'm sure for every report that says that, there's going to be another report that says work from home is either flat, effects are either flat or even beneficial. So I don't think we're going to know the answer for some time. If you ask me specifically what I think about, work from home, I worry a lot about the aspects of becoming a great worker and really participating in bigger decisions that senior leadership have to make, such as risk and setting goals of the company. If you're not absolutely engaged on a more regular basis in the office, learning how to navigate team dynamics, learning how to manage people, etc., and thinking more broadly about risk and goals. So we can go back and forth, and perhaps it's a generational thing because I'm much more older, and I grew up in companies when working at the office is hugely beneficial. And I think that still remains the same, notwithstanding the fact that it might depend a lot on whether you're creative or whether you're dialing in for sales conferences from home. So I think there's a lot of murkiness still, and let's see what happens in September. Once we see a reduction in a stimulus and people deciding whether or not they're going to go back to work for sure.
Dambisa, thank you so much, as always, for joining us, economist and author of How Boards Work. Dambisa Moyo there. Now, coming up, China's tech crackdown continues. Beijing has banned ride-hailing giant Didi from app stores days after its U.S. IPO. All of the details are up next. This is Bloomberg.
再次感谢曾经给我力量、给我能量的艾瑞克。
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome to the party.
Alex, I'm so thrilled to be here to finally celebrate our nation's birthday and to celebrate the return of live performances.
Yeah.
Country road, take me home.
Come on and go with me. Well, no hatred. Come go with me.
Some of our coverage there for the July the 4th celebration at the Boston Pops. U.S. stock and bond markets are, of course, closed today for Independence Day. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. Shares in supermarket group Morrison have soared this morning after Apollo Global Management confirmed it is evaluating a possible offer for the company. Over the weekend, the UK grocer agreed to a £6.3 billion offer from a consortium led by Fortress Investment Group. The deal is at a premium of more than 42% to the Morrison closing price prior to a first bid for the group. Shares in Sydney Airport have soared after a $17 billion takeover offer from a group including IFM investors in one of the boldest bets on a recovery for global travel. The consortium's offer for Australia's largest airport is at a 42% premium to the previous closing price, though still below the level it traded before the pandemic. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, China is expanding its cybersecurity review of tech firms. Ride-hailing giant Didi was removed from app stores on Sunday, just days after its U.S. listing. The Chinese government-backed Global Times newspaper says Beijing is acting for national security reasons. Well, joining us now is Sofia Orta-Ecosto, Bloomberg's China reporter in Hong Kong. Sofia, thank you for joining us. So what do we actually know about the probe into Didi?
Hi, good morning, Francine. So what we know so far is the cyberspace regulator, this is a new body in China, as you said on Sunday, ordered all app stores to remove Didi from their platforms. It's important to note that it hasn't banned existing users from using the app, so it's still not as aggressive as Beijing could be. Obviously, New York markets won't trade on Monday, but we already knew that Beijing was looking into the company, and we already saw a reaction on Friday with the shares falling as much as 11%, Francine.
So, Sophia, the probe was launched just a few days after Didi's IPO. What's the reaction amongst investors?
So what we're hearing, and the comparison here obviously is with Ant Group. That was the other big IPO in November. It was set to be the world's biggest IPO ever. We had $3 trillion worth of subscriptions for that stock. And as you remember, Francine, that was actually canned by Beijing 2 days before. So the question is really, why did Chinese authorities wait for the stock to start trading in New York? And that's the interesting difference here. It really is a lesson for U.S. investors. There is a sense that perhaps, there was kind of a nod from regulators in China or kind of a suggestion that Didi shouldn't go ahead with its IPO on the New York Stock Exchange, even though the regulator in China doesn't have the power to kind of cancel that IPO like it did for Ant. It can kind of guide companies and suggest maybe it is a bad time, it's a bad window for you to be doing this. But importantly, all of this came after the stock was already listed. So there is kind of a sense of, was this kind of a lesson for the company? Was it a lesson for U.S. investors that are looking to buy these Chinese shares? And is Beijing angry at the company for selling shares in New York and not in mainland exchanges or in Hong Kong, and not listening to the warnings that, this was a company that was under intense regulatory scrutiny, and it has been for at least 10 months.
So, Sophia, are we going to see other? I mean, it's not only about Didi. How many more others are touched actually?
Yes, exactly. So this is part of a very, very broad crackdown. These are companies that have grown, extremely rapidly. Remember, in China, there isn't really a regulatory structure. There's no comprehensive oversight of these tech giants who have amassed not just, a huge amount of capital. These are really valuable companies, but also an enormous amount of data. And that is now the focus for regulators in Beijing. What do they do with all this data? Especially if it is in the hands of U.S. investors, which is the concern kind of flagged by the influential Global Times editor. This is a company that has 500 million daily users, annual users, and it has so much data on Chinese citizens. Should it really be in the hands of U.S. investors? Any Chinese company with access to this data looking to IPO in the U.S. is unlikely to do so, I would say, Francine.
Sophia, thanks so much. Sophia Horta Acosta, Bloomberg's China reporter in Hong Kong. Now, coming up, oil markets are in turmoil after the UAE blocks OPEC's output deal. A positive jobs report, though, pushes the S&P 500 to a record for a seventh day. We'll get more on the markets next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the oil-fueled standoff between Saudi Arabia and the UAE is deepening. Abu Dhabi says it won't accept a plan to extend the output curbs beyond April 2022 unless it's given better terms, while the Saudis say they won't give in to those demands. Well, let's get more on the story. Our Daybreak anchor, Manus Cranny, joins us now for more from Dubai. Manus, so you also spoke to the UAE minister yesterday. What's the risk of a no deal here?
Well, the language from Sahil Al-Mazroui was, we're not threatening anybody. We want to be treated a little bit more fairly. Listening into your conversation with Goldman Sachs and Jeff Curry, it's the principle of unanimous consent, and that's what His Royal Highness Prince Abdulaziz bin Salman made the point. It is one against the rest of the OPEC Plus group, and herein lies the rub. He says that it's sad, and what even mystifies me is that Saudi Arabia and the United Arab Emirates not physically talking to one another. They chose to communicate to the market via Bloomberg television for the Emiratis. This is what he had to say to me, Francine. It's making two decisions. One of them is immediate. That is the production increase, Francine, of 400,000 barrels a day, which won't even cover the deficit, according to Kerry. That's required. The luxury, Francine, is that of the extension. And it's the extension that is the rub, and this is where it's all for one, and it's against the UAE at the moment. And Francine, if I can just encapsulate what's at risk here, it's 15 months of credibility building. That's what OPEC Plus have managed to do since the implosion in Vienna.
Yeah, I mean, it is a real risk, actually, you know, not only credibility, but at the end of the day, kind of, are we risking the recovery if the price of oil goes too high?
Well, $80, $85 is achievable, according to Goldman's in your interview, by the third quarter. Now, where is demand destruction? And in the middle of the Mazroui interview, and I've never heard a minister really as impassioned as this, for God's sake, we're in the middle of a pandemic. And this is the tonality of it. This shows you the tacit acceptance by the UAE of the need to extend production. However, it's how do you get there? The compromise is April 2022. The Saudis are playing the long game for Christmas of next year. That's what they say. It makes sense and give everybody the comfort zone. The language used by the Emiratis this time around is not one about walking away. We're not threatening. So this is going to be excruciating, painful, long negotiation today, and maybe a very late press conference. What is the elegant solution, Francine? Well, that's down to the Emiratis and the Saudis to work out. How do you bluff a market when it's very obvious there's a chasm between the two of you?
Manus, thank you so much. Manus Cranny there in Dubai. Now let's talk about the markets in general now with Bloomberg's Eddie van der Velde. Eddie, I mean, it's all about the oil price for the moment, right? If the Saudis hold firm and there's an oil price spike, could that force central bankers to then turn more hawkish sooner? So is this a domino effect?
I think so. Look, I think there is absolutely so much riding on this OPEC meeting today. You know, people can talk about how quiet the markets are, given the US holiday and so on. But if you take the implications of this OPEC meeting alone, the significance of it is just phenomenal. Because if we do see a breakdown of relations, and we do see this dragging on for another day or another, you know, throughout towards the end of the week, and we do see at the end of it a substantial increase in pumping from OPEC. Then what we see is we get all of those inflationary pressures that have been building up, and they get relieved quite significantly. And then, you know, that takes the pressures of the central bankers, and the central bankers can say, hang on a second, we can let this economy, we can let the job creation run a little bit longer before we start putting the brakes on. It really changes the dynamic of the conversation.
So, Eddie, how will the continued strength of the US economy actually play? Yeah.
Yeah, sorry, Francine, carry on.
No, sorry, I think we're actually going in the same direction. I was going to ask you how this all plays into the Fed's thinking on inflation.
Yeah, absolutely. I think the Fed, I think the Fed will be keeping a very close eye on oil prices because it's such a big input into the global economy, into the supply chain pressures that we've seen, into the cost of moving shipping. All of these things are impacted by the oil price. So I think this is absolutely the key element for me for today. At the same time, we're seeing those flash PMIs from Europe coming in today, and they're running a little bit hot. We're still seeing readings around 60. So, and I think most central bankers would be comfortable with that as long as the inflationary pressures are just taken off. And therefore, it's nice to see a united OPEC, but at the same time, I think a little bit more pumping would be welcomed around the world too.
Eddie, thank you so much, Eddie van der Walt there. I don't know whether we're bearing the leads. I want to know whether Mrs. van der Walt has yet agreed to a puppy or not. We'll get Eddie back to answer that very important question on this Monday morning, July the 5th. So Bloomberg Surveillance continues in the next hour. I'll be joined by Matt and Danny for a latest roundup of the markets. This is Bloomberg.
excluded from the workplace, especially when you've got skills and motivation and things to give, can have a really detrimental effect on people's well-being. They can become isolated, of course have the financial stress of not being able to support themselves. That might be their first entry into the broader community where you're building relationships with workmates, and so that's your exposure to culture and you're starting to feel like you belong.
Some people might need to practice their English more. They might just need just some practical experience in an Australian kitchen.
I have not from Australian friend. Now back in the kitchen, I have many friends.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
They've never brought that complaint before, even after signing, immediately or before signing the April agreement.
We sacrificed a lot. We will continue
to sacrifice until the end of this agreement. That's our commitment.
But to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend.
But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Well, good morning, everyone. 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Monday, July the 5th. Our top stories today. High-stakes standoff. Saudi Arabia and the UAE ramp up the tension in their OPEC dispute over oil production. China tightens its grip. Beijing expands its latest crackdown on the tech industry beyond ride-hailing giant Didi. And Joe Biden's mission accomplished moment. The president all but announces an end to the pandemic in the U.S. Well, good morning, everyone. I'm Francine Lacqua here in London. Matt Miller in Berlin. Danny Berger in for Kaylee Lines, who's off today. Danny, I don't know whether we say like happy July the 5th or happy the day after July the 4th, but to all of our American friends, we hope we had a wonderful weekend.
Yeah, happy day after Independence, happy hangover Independence Day. I'm not totally sure what it is, but hey, if the U.S. is off, then I guess it's some sort of celebration. And we do have cash markets closed in the U.S., but of course, we have futures trading, we have drama in OPEC, so that's certainly what's guiding markets so far. So let me show you those. Looking at Brent crude, it had been stuck in a range slightly higher today, about its highest since 2018, more than $76 a barrel. The potential risks here of OPEC are so disparate. You have at one end potentially the current agreement just continuing through, which would be really bullish for the markets, or you have a complete breakdown, a complete free-for-all, which would definitely be a more bearish scenario. So it's a kind of paralyzed trading that we're seeing. As I said, futures still trading in the U.S. You have S&P futures down by 0.1%. You have the 7th consecutive high ending on Friday after that jobs data. You have a 10-year bond, which is having a slight bit. Again, volume's really, really light here, given it's a holiday. And you do have a little bit of weakness coming through to the dollar. That weakness starting after the jobs data. This idea of a Goldilocks data coming through that is positive for the economy, but not enough to get the Fed moving. Now, the other market story we're also tracking today is China, and they continued crackdown on big tech. This time around, it's ride-hailing app Didi. But look at today's session, really remarkable. We start the day basically unchanged, a little bit weaker after this lunchtime break. But as we end the day, Chinese shares, the CSI 300 rather, ending the day higher. Tech even ending the day higher as well. Now, finally, the markets over here in Europe seeing a little bit of weakness starting through in this morning. Just fractional here, though, 7 basis points lower. One thing that is helping to lead the index higher is the basic resources sector, just because commodities and oil are stronger today. And finally, when it comes to companies, Matt, I know you're going to be obsessed with this story because, as you always say, the UK loves a good grocery story. W.M. Morrison first getting a bid from CD&R. That bid then one-upped from Fortress Investments. And then finally, we got a new bid or a potential bid with Apollo looking at them. We're also seeing grocery store Marks & Spencer's raise higher. But Matt, I would put it to you, every single private equity firm that is bidding for Morrison's is American. So I would say Americans are more obsessed with UK grocery stores than Britons
say
are.
So. I'm totally on board with you. To me, this says that the UK cares a little bit less about their own assets than other players. And wouldn't it be ironic, post-Brexit, right, you want to leave the European Union and fend for yourselves, but then foreigners come in and buy all of your assets, which is why? Do you not have the money? Is there no appetite for supermarket assets? Is it enough to have Tesco, Waitrose, and Sainsbury? Don't you want Morrison's as well? Every little helps, you know? So, yeah.
I love it. The ultra-liberal now kind of like pushing for protectionism in the UK. I love it. Happy July 5th.
Not protectionism, just a little bit of national pride is what I'm thinking about on this July 5th holiday. Let's take a look at what's coming up ahead. The OPEC Plus alliance is due to meet. Again, you heard the UAE minister demanding time to talk. Well, those talks have been halted twice. The standoff between the UAE and the rest of the group has so far left markets in limbo over the future of production. On Wednesday, Allen & Company's Sun Valley Conference, the big famous media turned tech, now back to tech conference, kicks off. Jeff Bezos, Mark Zuckerberg, Warren Buffett, and Tim Cook are all among those invited. The guest list is long, and it's going to be sweet. Also on Wednesday, we're going to get minutes from the latest FOMC meeting, as well as U.S. job openings data. For May, we'll be paying close attention to the jolts this week. And on Friday, G20 finance ministers meet in Venice at what has got to be a fantastic time to be there, because there's no cruise ships around Venice. There aren't the tourists that usually ruin the experience. Not sure how much time they'll be able to, use to see the sights, but Janet Yellen will be there, and it's a gathering that is supposed to be the deadline to wrap up talks on the plans for a global minimum tax. So we'll see if they can get everybody on board for that. Francine?
Yeah, I don't know how it's sightseeing, but certainly it is, I've heard from reliable sources, family in Venice, that actually it's less busy than usual. Now, the standoff continues within the OPEC Plus alliance as Saudi Arabia has pushed back against the UAE's opposition to a proposed production increase. In an unprecedented move, both countries have aired their grievances on television. First, the UAE Energy Minister, Sohail Al-Mazrouei, spoke to our Manus Krani in Dubai.
And just to be clear then, sir, you've not threatened to leave OPEC, and right now you're not prepared to threaten to leave if you don't get a deal.
No, I think if we don't get a deal, then we have an agreement to fulfill. We are not now close even to elapsing that agreement. We're not threatening to walk away from the agreement. We're not threatening, we haven't threatened anyone. UAE is not going to be an obstacle in front of anyone. But we are not going to threaten. That is not our strategy. We have been sacrificed. We sacrificed a lot. We will continue to sacrifice until the end of this agreement. That's our commitment. But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
Well, responding to the UAE, Saudi Energy Minister Prince Abdulaziz bin Salman spoke exclusively with Bloomberg's Anne-Marie Horder.
I would emphasize that it is the whole group versus one country, which is sad to me, but this is the reality today.
And how concerned are you if there is no agreement and potentially we could see what we saw last year, which becomes a price war?
We have an existing agreement, Mary. I keep reminding people, unlike what you had in March, we have an existing agreement. We will honor that agreement. We will continue with it. The agreement requires that we bring more production, yes, but to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend. Again, the extension put lots of people in their comfort zone. It brings volumes to address the short term, but it also addresses for the market. Check with all those who are participants in this market. Tell them.
The current agreement, if not extended, has no production increase for August. So if not every member signs up tomorrow, what happens in August?
Well, it's your chance to have another maybe interview with me tomorrow or after tomorrow. It depends on how we will finish.
Are you worried we could see a massive spike in prices because the market is in need of more supply for the month of August?
If some people would like to have that, they can do that. Is it our intent? No. Because if it is our intent, why would we do the proposal? And why we would work with our colleagues? It's been a 2-month affair.
If you're on board with the proposal, Russia and the rest of OPEC is, and there's just one holdout, and that's the UAE, will you continue to increase by 400,000 barrels a day without the UAE on board?
We cannot. Because it's an agreement that is done by consensus.
Well, that was Bloomberg's Anne-Marie Hardern talking exclusively to the Saudi Energy Minister, Prince Abdulaziz bin Salman, and Manus Krani speaking with the UAE's oil minister on the spat dividing OPEC+. Now let's get more on this pretty big spat with our Bloomberg executive editor for energy and commodities, Will Kennedy. Will, thank you for joining us. We also spoke to Jeff Curry a little bit earlier on, and he says, look, OPEC+ will likely approve a deal without an extension. What happens if they don't?
What happens if they don't? I think it's a little unclear. As you heard the Prince say, then the current agreement stays in place, which would have them stick at existing production levels until next spring, which, as Anne-Marie said, would be probably extremely bullish for prices because the market is expecting 400,000 barrels a day next month and in subsequent months. And if the impasse continues, that might not get it. But there is a risk on the other side, of course, that this leads to a complete breakdown in OPEC. Now, Mazrui, in his interview with Manus, obviously clearly walked back from the idea of the UAE leaving OPEC. But the risks are still there that this breaks down the alliance and that, people have the opportunity to put more oil into the market. So I think one of the reasons you've seen prices not move a huge amount today is because you can construct arguments, narratives in both directions, and traders really need to see the outcome of today's meeting before they can take a position.
So, Will, as I understand it, then, good, if they leave the agreement in place, that's pretty bullish for prices, but not as bullish as an unraveling of OPEC would be bearish, right? The risk is pretty asymmetric because if this spat continues and blows up, then you could have a price war once again.
Yeah, I don't think anyone's saying that's a likely scenario at the moment, Matt, but it is a possibility. And we saw a year ago what that kind of price war can do to the markets. But I would be cautious on that scenario. Clearly, a year ago, that was something that the Saudis were thinking about going into that meeting in Vienna, March 2020. They had game plans and scenarios in case everything broke down. I think at this stage that isn't happening and that everyone is trying to find a route forward. But it's clear from the interviews that we had yesterday that both sides here, the key players, Saudi Arabia and the UAE, are very entrenched. I think it will be very interesting to hear from the Russians today. They are the other key player here. We haven't heard from them the last couple of years. They will be desperate for a deal to happen, so maybe they're the key to unlocking something.
Well, it does seem remarkable that this dispute is taking place in such a public forum, hearing from these energy ministers on Bloomberg, basically debating each other via this television network. I mean, do we have any idea whether they're talking behind doors, what those lines of communication look like, or are they breaking down?
I think you're exactly right, Danny, to say that this is an indication that things are not going well. When you end up in this sort of public war of words, it's not a sign that there are meaningful diplomatic efforts going on behind the scenes. And I think that's our understanding. We had heard perhaps that Kuwait was trying to broker a deal at one point, but as we understand it, and there may be things happening that we don't know about, but our best information of this is that, as I say, these positions remain very entrenched. Going public like this will raise feelings and force people to see it personally. So, we'll just have to see what happens at this meeting. But I don't think right now there is a meaningful diplomatic effort underway to solve this. That might change, but right now it doesn't seem to be that.
Yeah, well, I mean, again, when you speak to, the head of commodities at Goldman Sachs, he says, look, it's very uncertain, or I think the exact words is extremely unlikely that this will degenerate into the price war that we saw between Russia and Saudi Arabia last year. But is this just because they can't afford for it to degenerate and have an impact on the oil price? Is there, when you look at the drama between these two countries, how much of it is political and how much of it is actually to do with the oil price?
I think for the Emiratis, it really is about their oil industry and the constraints that they feel that this deal puts on their oil industry. They are right to say that they give up more spare capacity than any other nation in the OPEC alliance to keep this agreement on track. So the extension for them is a problem because they were expecting that situation to end next spring, and now everyone wants it to continue towards the end of 2022. That said, I think that the Saudis and others in OPEC would argue that the Emiratis expanded production of their own volition, and it's not their problem that the Emiratis are so constrained. So there are arguments on both sides. I think you're right to say that they don't want it to break down. So, sorry, to go back to your question, yes, it's mostly about oil, but clearly the political alliance between Abu Dhabi and Riyadh isn't what it wants. In the background here, there are other tensions that we've seen in differing strategy about over the war in Yemen, for example. So I think oil first, but the political background probably isn't helping yet here.
Well, thank you so much. Our Bloomberg Executive Editor for Energy and Commodities there, Will Kennedy. Now, we'll have plenty more, of course, on the oil markets. We'll also look at FX in depth. And then the other story is not only Didi and China cracking down, but it's that ransomware. Full story coming up. This is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
If you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in Berlin with Francine Lacqua and Danny Berger in London. Kaylee Lyons is off today for the 4th of July holiday into the 5th of July. Now, jobs in the U.S. jumped by the most in 10 months, despite unemployment ticking slightly higher, a mixed report supporting the Fed's patient approach as hawkish bets fade.
This jobs report was actually pretty mixed. This is a mixed report.
Some mixed points to this.
For every positive thing you point to, there's something less positive.
Both kind of bulls and bears in the economy have something to chew on.
There's a little bit here for everybody.
You have to step back and put some perspective, though, on that.
It's about supply, not demand.
Supply side bottlenecks, that are pushing up prices are actually impacting real activity as well. People pour over the jobs report because they're wondering what the Fed's going to do with it. And I think the answer is
it confirms a wait and see approach.
What happens if you let the inflation genie out of the bottle?
Look at what's happening in wages.
3.6% was the average hourly earnings growth.
It baffles me that they haven't started tapering already.
There's just too much liquidity.
Lots of unanswered questions that will need to be answered.
All right, so we have some interesting data for the moment, Francine. Of course, we're all waiting for the JOLTS data, and as we know, things could turn on a dime here, but I don't know, maybe this is why rates on the 10-year stayed so low?
Yeah. Yeah, I mean, I think, look, Matt, we look at the data, we look at maybe what the ECB also says on inflation, and oil is probably the biggest unknown when you look at, the price of oil and how that could feed into inflation, how maybe the Fed and other central banks view inflation going forward. It is this week, yeah.
Yeah, absolutely. I mean, The thing is, there are a lot of people out there who still see inflation as something more than transitory. But what I can't get through my head is, are we really that afraid of 3% inflation or 4% inflation, given what Eddie and I have lived through? I guess you and Danny probably not. We saw much higher inflation when I was a kid. Let's bring in Eddie Vanderwalt right now, Bloomberg MLive editor. Actually, I'm sorry to assume that you're as old as I am, Eddie, because I know you're not quite.
I'll take the compliment.
I think I'm probably older, but let's not.
Look,
I'm probably old, but let's not go into that. I've just aged well.
Let's keep it private. What do you think about the inflation debate and where the Fed is considering a 10-year Treasury at 142 right now?
Yeah, I think I'm with you. I accept that, inflation running a little bit hot when the central bankers have so much firepower in reserve, right? It's not as if they've been fighting inflation and not been able to control it. They've had a number of years where they've not been able to get it above target or anywhere near target in the case of the Eurozone. So I think they would be quite comfortable in seeing inflation pick up. But I think there is a generation of people for whom inflation is such a terrible memory that, they just don't want to ever go back there again. So I think there's a number of people who are so worried about this that, any beat above target will be seen as extremely negative. At the same time, you've got assets like cryptocurrencies that have sprung into life purely because people have said, look, the central bankers are experimenting, they don't know what they're doing with your money, and the whole thing's going to end in tears. So I think there's that narrative in the background that's playing as well.
Eddie, thank you so much. Eddie Vanderwalt there from our MLive team. We'll get back to Eddie shortly. Now, coming up a little bit later this morning, Joshua Sharfstein. He's Johns Hopkins Bloomberg School of Public Health Vice Dean. We'll ask him, of course, about the variant, COVID, and also mask wear. This is Bloomberg.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Kaylee Lyons is off today. Now let's get straight to the Bloomberg First Word News. And President Biden has all but announced an end to the pandemic in the United States. He celebrated what he called the heroic vaccination campaign on the country's Independence Day holiday. Now the president missed his goal of having at least 70% of adults in the U.S. getting at least one dose of vaccine. The total is now 67%. The hackers behind a mass ransomware attack exploited previously unknown vulnerabilities in management software made by Kaseya. Well, that's according to cybersecurity researchers. Hundreds of businesses were affected by the attack. A Russian-based hacking group is suspected. We'll have plenty more, of course, on these stories throughout the day. Now, coming up, Holger Schmieding, chief economist at Berenberg. We'll ask him about the price of oil. We'll ask him about inflation. And I know Matt Miller also wants to talk about the German elections. This is Bloomberg.
Freedom delayed 4 more weeks. That's the delay expected to be added to the lifting of all lockdown restrictions in the UK. It had been due to happen on June 21st, but UK Prime Minister Boris Johnson to address the nation later today and to push that date into July. It's all down to a surge in the Delta variant, and government ministers thought to want more people to have their second COVID vaccine before they ease all restrictions. How are markets responding? Well, they're largely taking it in their stride. The FTSE 100 actually gaining ground. Strategists saying that delay largely priced in, that we could see further weakness for travel and leisure and hospitality stocks. The pound falling against the dollar, though Nomura saying this weakness likely to be temporary. In fact, money markets largely bullish on sterling, given the pace at which economic gloom has been lifting here in the UK. Indeed, last week's GDP figures pointed to an economy that is recovering quickly, and later this week we'll get unemployment, inflation and retail sales data that should all further illuminate the economic recovery.
Curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
No. Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua with Matt Miller and Danny Berger. Katie Lyons is off today. Matt, a lot of the focus is the day after the 4th of July. Let's be real. So the market may be a little bit less in terms of volume, but the focus is also firmly on this terrible spat within OPEC.
Yeah, I mean, I think it's really dramatic and fascinating to watch. That as well as the Didi situation, right? Because the OPEC situation you can sort out and you can understand the moving parts. The UAE wants to change the baseline. Nobody else wants to let that happen because then everybody would get to change the baseline. Totally get it. With the Didi thing, is China angry that Didi has the data because they want the data? You assume that China has the data if Didi has the data, right? So, or is it just an elaborate prank on U.S. investors who just bought Didi shares last week? It seems like
the timing is incredible.
Yeah, the timing is unreal.
Yeah, I mean, I was going to say, you have to wonder, okay, obviously this is a big deal for China tech in general, but what does it mean for the U.S. IPO market? We have so many Chinese companies listed in the U.S., Francine. I mean, does this mean no one will ever want to do it again?
Danny, I think it was probably a very clear message for U.S. investors that played into the IPO. So, I mean, I don't know if that's really playing out in the markets or whether, you know, it's really oil and inflation concerns.
That definitely seems to be what's capturing the attention of the market. Yeah, Matt?
I want to just make one point because you hit on something really interesting, Danny. Does that mean nobody else is going to want to invest in these companies again? And Shuli Ren has a great piece on Bloomberg Opinion. The Chinese have an expression for U.S. investors that bought Didi. It's called chives, and the reason is you can harvest them and they grow right back up again. So I think some people, at least, feel like these U.S. investors are just going to keep buying in no matter how much they get the rug pulled out from under them. I highly recommend checking out Shuli Ren's column.
Well, that's kind of the appeal of the U.S. market in general, right, Matt? I mean, we continue to see new record after new record. I mean, it's no wonder that if you're going to list, and especially if you're a big tech company, that's where you would want to be. And let's go ahead and look and see how the markets are doing so far this morning. I do have a China board for us in just a little bit, which is remarkably unshaken. Now, you are seeing S&P 500 futures lower this morning. Unlikely it's just because of the DD stuff. I mean, look, there's barely any volume both here in bond futures just because, you know, it is the 5th of July, the day after 4th of July holiday, so not a lot of trading going on there. And Francine, as you were saying, really what's capturing the attention is what's happening in OPEC. Oil not moving a ton, it's still around a 2018 high, but because there are two very different outcomes, a very bullish one or a very bearish one, depending on whether we get an agreement, whether the UAE comes back to the table or not, there's a lot of variety, so you don't want to make too big of a bet in a very nervous and tight market. Finally, we are seeing a little bit more weakness in the dollar. Now, let me quickly show you what happened in the Chinese session, and it was, you know, a so-so day. Ended up about 0.1% higher. Now, part of the reason we maybe didn't see that big of a sell-off was that Friday was just really, really tough in the equity market in China. It had its worst sell-off in about 4 months. So people going back in buying, but even tech ending higher in the day during today's session. Europe, on the other hand, under a bit more pressure when it comes to the trading session today. It's basically unchanged to a little bit lower. The thing that's keeping it afloat really is basic resources when you have commodities going higher again. And Matt, I come back to the WM Morrison story. Shares up more than 11%. One thing that caught my eye was analysts over at SocGen saying that, okay, now you have all these private equity funds bidding for Morrison's. It's also helping give a lift to Marks and Spencer's, for example. Maybe Amazon could be a player here. Maybe Amazon wants to come in and make a bid now that they know that Morrison is for sale too. I mean, that definitely would garner a much higher price from Morrison than any private equity company could put up.
Wasn't there already a cautionary tale with a huge U.S. retailer buying a U.K. supermarket chain that just didn't go so well? I'm thinking Walmart and Asda.
Yes, and funny it should happen that one ended up being bought by a private equity fund in the end also.
Yeah, well, we'll see how the exits are if private equity actually gets in to these. I am tuned in. Right now, let's talk about Well, we haven't touched on coronavirus at all, so I feel like it's time. The Delta variant spread across the U.S., threatening to cloud recovery outlooks, putting a growing chorus of investors on edge.
The Delta variant.
The Delta variant.
The spread of the Delta variant.
The Delta variant is going to be an issue.
Definitely, it is right now the key tail risk to watch.
The risk is there. It's the major visible risk.
And it could potentially derail things.
The travel restrictions are still in place in many countries.
That can open the pathway for lockdowns. Later.
Economic growth forecasts could roll over. But the issue is that the central bank's responsibility is also for looking at the economy, at inflation.
This is the risk that we all have, on our radar, right? The Fed crunching the recovery.
That's still the big uncertainty.
Central banks have to calibrate very, very carefully.
Joining us now is Holger Schmieding, chief economist at Berenberg. And Holger, I wonder how bad or how scary the Delta variant really is in the Western world now that anyone who chooses to is able to get vaccinated, and those who have been vaccinated are at a far lower risk of becoming seriously ill, certainly very unlikely to be hospitalized, and incredibly unlikely to die from this. So is it really that big of a problem here?
I would say it is a big risk that we need to watch. As economists, we can't really judge the medical situation, but we do follow the data very closely. And the data do show that so far, indeed, as you said, among populations where many people have been vaccinated, serious medical complications are fairly rare. And that probably means that we will not be heading for new serious and crippling restrictions. It's early days, but the evidence such as that from the UK is in this sense encouraging. There is also a political angle to that, as the medical complications seem to be largely occurring, the few, among those who have not been inoculated. The political argument is, once there are enough vaccines for everybody to have the ability to get a shot, at least for those above a certain age group, then the political reason that in order to protect those that have not been inoculated, we need to have blanket restriction, that political reason basically goes away. Those who have had the chance to get inoculated but haven't chosen to do so are probably not the ones which the rest of the population would take restrictions or accept restrictions to protect. So in other words, our economic base case remains no new harsh restrictions.
Yeah, I was going to ask you, actually, what does that mean for the drag on the economy?
That means the drag on the economy will likely be minimal. We have seen already that kind of from wave to wave to wave of infections, the economic reaction to that has declined. In the UK at the moment, we see a modest drop in footfall, retail, recreation growth rate, but we do not see other indicators, such as what we just got, the services PMI, showing any significant damage. Instead, they were strong. So we seem to be, in countries where most of the adults have been inoculated, we seem to be seeing a decoupling of the economy from the infection situation. In other words, we are returning to a situation that we economists would normally sort of call normal, that the medical situation is something to be watched, but not the prime mover of our economic forecast.
Okay, if these economic picture then, if the data coming in then does suggest, Holger, that we're starting to get an improvement, how do you contrast that with, for example, a market where credit spreads are really tight, things that kind of seem to scream late cycle economy? How do you square the two?
I don't think we are like late cycle economy. We do have, of course, to watch inflation risk, which is a bit of a late cycle phenomenon, yes. But in terms of the underlying economic dynamic, we likely have a long period of fairly strong growth ahead of us. We have the rebound from the pandemic. We have a strong monetary and fiscal stimulus. We have excess savings. We have, on the business side, a need to invest more and to replenish inventories. So we are, in terms of demand, nowhere near a late cycle situation. We have to watch inflation, that's true, but central banks are a bit more tolerant of inflation as they used to be. So for the time being, it looks likely central banks will take the foot off the accelerator gradually. but they will not step on the brakes and end the cycle. So I'm not that concerned about late cycle rhetoric.
Holger, what's more dangerous for the economy right now? Is it something going wrong with OPEC Plus and the agreement, or is it too much stimulus at exactly the wrong time?
I don't think that we should worry too much about OPEC. I'm not an expert on that, but these spat will likely get resolved before they turn into something that's really serious for the world economy, beyond, say, the impact on markets for a few days or weeks if we are unlucky. Of course, overheating, too much stimulus is a bit of a concern. Having said that, we probably are beyond the biggest stimuli. I don't think there will be other big stimulus checks sent out to U.S. households in the future. It will be a more measured and more supply-friendly programs, hopefully on more infrastructure spending, for example. And hence, with no further stimulus checks in the U.S., we'll probably see more workers who probably sort of don't bother to really look for a job, return to the labor market and ease the labor supply constraints a bit. I'm a bit worried, but not too worried about this too much stimulus at the moment.
Holger, thank you so much. Holger Schmieding, their chief economist at Berenberg. Now, coming up, China's tech crackdown continues. Beijing has banned ride-hailing giant Didi from app stores days after its U.S. IPO. All of the details next. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is Bloomberg Surveillance Early Edition. I'm Francine Lackwith, Matt Miller, and Danny Berger. Kaylee Lyons is off today. Now, China is expanding its cybersecurity review of tech firms. Ride-hailing giant Didi was removed from app stores on Sunday, just days after its U.S. listing. The Chinese government-backed Global Times newspaper says Beijing is acting for national security reasons. Well, to talk about all of this is John Liu, Bloomberg News executive editor for Greater China. He joins us now from Beijing. John, thank you so much for joining us. When you look at the timing of this, is this also to try and get to U.S. investors because of its recent IPO in New York?
The exact sort of thought process behind the timing here is a little bit unclear. I think it's worth mentioning that national security, data security is more in the limelight than it's ever been. Just as China is doing this review of Didi, you know, it should be mentioned that Washington is also doing this review of companies like TikTok, whether those operations, TikTok's operations in the U.S., are putting the data of American citizens, exposing that to the Chinese government.
Yeah, so the Chinese government is going to know all the dances that American teenagers are doing. I wonder who has access to Didi's data. I mean, you have to assume, right, that the party can access any Chinese company's data it sees fit to access. But is the concern that the U.S. may also have access to Chinese consumer data?
So the Global Times article that we mentioned earlier, that actually noted that the data that Didi has on where people travel day in and day out, there's so much of it that you could work out a pattern, and that would be a national security concern. They also note that the two biggest shareholders in Didi are SoftBank and Uber, two foreign companies. Uber, obviously, an American company. So I think the concern being suggested there is that the shareholders not being Chinese is somewhat of a security threat.
Yeah, SoftBank not exactly having the best run over the past couple of years, are they? John, there are also other firms that China has announced that they're looking into as well. Can we derive any hints from, you know, sort of all the companies that they're investigating? If there are any common takeaways that can lend us to understand exactly why they're looking at them?
So the two other companies that have been announced that are under scrutiny are the Full Truck Alliance, which is sort of an Uber Didi for trucking, and then also Kanjong Limited, which operates a job posting recruiting website. I think both those websites have data about people, personnel, what people are doing, what they've done, where they've worked. I think it shows that the political tensions between the U.S. and China, they're more in the market than they've ever been. You obviously also have Washington looking at banning American investment in Chinese companies listed in the U.S. So I think this is just showing an intensification of that.
John, thanks so much. John Luther, Bloomberg News executive editor for Greater China, of course, reporting from Beijing. And I know this story will run and run, so we'll look at different angles, of course, with our reporting team on the ground. Coming up, billionaires race to space. We'll bring you some of our interview with the Galactic or Virgin Galactic chief executive, Michael Colts-Glazier. That's up next, and this is Bloomberg.
Every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Francine Lacqua and Matt Miller. Kaylee Lyons is off today. Now, Richard Branson is planning to fly to space on July the 11th, and that's just days before a similar trip by fellow billionaire Jeff Bezos. The CEO of Virgin Galactic discussed founder Branson's plans with Bloomberg's Guy Johnson and Kaylee Lyons.
We do now have a clear license from the FAA to do commercial sales. That won't happen until 22 after we finish the flight test. However, after the second of these next two upcoming flights, as planned, we will be reopening up sales to the marketplace, and we're excited for that moment. That'll be late summer, early fall.
Well, that was the chief executive of Virgin Galactic. Now, look at what else we're watching today. There's a lot going on. Danny, OPEC, I mean, this is probably the big one, a meeting again today.
It is, and I have to say, it probably doesn't bode well, as we were discussing with Will Kennedy, that a lot of the debates seem to be taking place across Bloomberg TV. I mean, they're going very, very public with it.
Us.
So, yeah, exactly. It's going to be really interesting to see, you know, what does that evolve into? Are we going to continue to get a more public view of the disagreements that they're having, Matt? I mean, it means a lot for the oil market here because the potential outcomes are so extreme.
Yeah, I'd have to agree that that is the number one issue to watch for markets right now. Definitely keep your eye on what happens, and we'll continue to have, well, you saw the Saudi oil minister inviting Anne-Marie to interview him again tomorrow. So maybe we'll get more of that. I'm going to also be watching the UK supermarket battle because I know I make fun very often, but I do care. I have my own favorite UK supermarkets. I've got them listed in order. I don't think it'd be fair to say right now, but Waitrose makes the best cheesecake in the world. We'll be watching to see who takes over Morrison and if any Brits step up. I'm not advocating for protectionist measures from the government. I'm just thinking maybe some UK investor will think it's important enough to buy this supermarket chain. And to me, Francine, the most interesting thing is they own like almost all of their stores. I think they own like 85% of their real estate, which must make it worth more.
Yeah. Matt, I love the fact that you live in Berlin. I haven't lived in the UK for quite some time, but still have a list of favorite supermarkets. That's why we love Matt Miller. He's always on the ball.
BLTs at M&S are delicious.
Oh, there you go. Supply chain disruptions raising costs for European companies as firms pass on higher prices to consumers amid surging demand. Well, the French industry minister, Agnès Pannier-Runacher, weighed in.
Is now to have the most people being vaccinated in the less time possible and to ensure that we have a close monitoring of the circulation of the variant. And this is exactly what we are doing. We don't have issue with number of vaccine doses. The people are getting vaccinated. We don't have a threshold yet, but we do know that at a point of time we may have this threshold of vaccination, and we will need to push more vaccination among people.
So it is possible that this Delta variant could derail the very high growth forecast that France is enjoying at the moment, 5% for 2021. It's possible it could derail this forecast?
We don't think so, because we have taken cautious figures. As you know, we say 5%, INSEE is now saying 6%. We will not move our targets because, you know, it can go up and down, and we want to be to have a steady approach. But I'm confident that we can deliver this 5%.
The pandemic has also had a dramatic impact on the prices of raw materials, causing inflation. Do you think this will have also an impact on French growth, and this will have an impact, a lasting impact on the French industry?
We have some factories that have to slow down their production. They have a huge backlog, but they don't have the parts to produce yet because there are huge delays in production in Asia or other parts of the world. When it comes to pricing, by the end of the year, we believe that the inflation should be, you know, in a acceptable level. We don't have warnings regarding that. But once again, this has to be closely monitored, and that's why we're anticipating it by having some policies to re-implement, to relocate some production in Europe, in France, and to have a nearshoring approach.
President Macron is planning to revive the very controversial pension reform quite soon, before the end of his mandate, obviously, and the presidential elections in 2022. Do you think it's the right time, even though it could create another very tense social climate and possibly return of the yellow vest protests, for example?
President Macron has always been clear that he would not stop reforming the country because of COVID or whatever. We need to transform France, and we will carry on implementing reforms. Having said that, we need to have a pension reform, because at this moment of time, this is the scheme, the pension scheme is not balanced, it's not financed yet. That means that the younger one pay for the older one, but they don't have the insurance at all that they will benefit from the pension scheme at the level of the older one. And this is absolutely unacceptable. So we need to move forward with what calendar the president will tell, but for sure, reforms are still important in France.
Well, that was the French Industry Minister, Agnès Pannier-Runacher. We'll have plenty more on Bloomberg Surveillance. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada's going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
They've never brought that complaint before, even after signing
immediately or before signing the April agreement.
We sacrificed a lot. We will continue to sacrifice until the end of this agreement. That's our commitment.
But to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend.
But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
Welcome to Bloomberg Markets on this Monday, July 5th. I'm Matt Miller in Berlin with Danny Berger in London. High-stakes standoff, as you just saw there. Saudi Arabia and the UAE ramp up the tension in their OPEC dispute over oil production. We'll continue to cover that for you. Plus, China tightening its grip. Beijing expands its latest crackdown on the tech industry beyond ride-hailing giant Didi. They pull others into the national security concerns as well. And Joe Biden's mission accomplished moment. The president all but announces an end to the pandemic in the U.S. So, is the mission really accomplished? We'll talk about that as well. Danny, what are you seeing in the markets?
Matt, I mean, we didn't get the number. What was it? Above 70%, and then you had AB InBev giving away free beers. I mean, we didn't get that number. How can it be mission accomplished if
I don't
not
think
everyone
it is
in the
mission
U.S. is getting free beers?
But I think they'll spin it that way anyway. That's just how politics works.
Right. I mean, look, the vaccine rollout is going on, so that is good news that people are getting vaccines. Now, when it comes to the data, we have had days where vaccines are front and center, but Matt, it really is all about OPEC today. I mean, look, if you have the U.S. market closed for the July 5th holiday, you have most of Europe probably not feeling great this morning after celebrating the Euros this weekend. It's going to be the Middle East that takes center stage, and we are seeing Brent at its highest since 2018, up more than 0.3%. You have two possible outcomes at the extremes. Of course, there's some in between. Potentially, you have not an agreement reached, and that's very bullish, or you don't have one, and then that's very bearish. Now, looking at the CSI 300, this one's interesting because we had China continuing to crack down on big tech, focusing in on Didi, still Chinese markets unchanged. Looking in Europe, actually moving higher, had been negative for most of the day, but now the Europe Stock 600 just slightly up. Basic resources leading those gains thanks to stronger commodity prices and thanks to the grocers today. Basically, every grocery store stock in the UK is heading higher after what seems to be a bidding war for Morrison's. Currently, Apollo looks like they might get involved, might put a bid in for Morrison's as well, because Matt, as you know, the Brits love their grocery stores, but private equity funds in the US love them even more.
Yeah, absolutely, and it'll be interesting to watch who gets that as the price continues to ratchet higher. Let's take a look at what else is going on this week. We've already talked about, and we will continue to talk about OPEC, not just because it's dramatic and exciting, but also because it's so important to the markets. The alliance due to meet again today. Talks have been halted already twice. The standoff between the UAE and the rest of the group has so far left markets in limbo over what further production is going to look like. On Wednesday, you see Allen and Company's Sun Valley Conference kicking off. Jeff Bezos, Mark Zuckerberg, Warren Buffett, Tim Cook, all among those invited. It's going to be a huge guest list and probably totally rule to be there. Also on Wednesday, we're going to get the minutes from the latest FOMC meeting, as well as the U.S. JOLTS, the job openings data for May. We'll be poring over that and paying close attention to. Always exciting, frankly, but especially now. On Friday, G20 ministers will meet in Venice. There'll be a group picture for sure in St. Mark's Square. The gathering to be the deadline to wrap up talks on the plans for a global minimum tax. Supposed to be the deadline, but we know how this works, right? If not everyone agrees, it won't be the deadline. Surely they'll continue to try. Danny, that's just how it goes, and there are some holdouts, especially those who currently have tax rates below the global minimum tax rate. Most of the countries who agreed have tax rates above the global minimum tax rate, so they just have to pull them down. Seems like a lot easier than pushing taxes higher, right?
Yeah. But even those countries, and I'm specifically thinking of the U.S. here, Matt, might not be a sure thing because it has to get approved by Congress. I mean, that is surely an obstacle in the U.S. as well. So it's not just those high-tax countries as well. Sticking with the U.S., though, we saw jobs in the country jump by the most in 10 months, and that's despite a higher unemployment rate. Now, bets on a more hawkish Fed are starting to fade with a mixed report supporting the central bank's patient approach.
This jobs report was actually pretty mixed. This is a mixed report.
Some mixed points to this.
For every positive thing you point to, there's something less positive.
Both kind of bulls and bears in the economy have something to chew on.
There's a little bit here for everybody.
You have to step back and put some perspective, though, on
it's about supply, not demand.
Supply side bottlenecks, that are pushing up prices are actually impacting real activity as well.
People pour over the jobs report because they're wondering what the Fed's going to do with it. And I think the answer is
it confirms a wait and see approach.
What happens if you let the inflation genie out of the bottle?
Look at what's happening in wages.
3.6% was the average hourly earnings growth.
It baffles me that they haven't started tapering already.
There's just too much liquidity.
Lots of unanswered questions that will need to be answered.
Some of the views from our guests over the past couple days. Let's also get the view from Christian Schultz, a Citi European economist. Christian, thanks so much for joining us this morning. Listening to those, I mean, is this a fair assumption to say we're in this Goldilocks period when it comes to the data, that the jobs data coming in strong, suggesting the economy is recovering, but not enough to make the Fed move? Is that where we are right now?
It's enough to keep the Fed on track for our call, which is that later this year we get the tapering announcement. December it really starts. The tapering then goes sort of on plan towards the autumn next year. The first rate hike happens in December next year. So on track, nothing that deviates up or down from that path, I think, and therefore probably mixed is a good description.
But to what extent, Christian, can we even trust the data at this moment? Many people like RBC point to a lot of the volatility in the numbers, given seasonality effects, given base effects. Are we at a point where we can take the data at face value?
Well, I'm not an expert on the U.S. labor market data. The one, I think, distortion that we have to take into account is in wage growth, where we have these compositional effects of, different types of people have lost their jobs it's mostly people in lower earning jobs who lost their jobs during the crisis, and they are now returning to the labor market. That is distorting the labor market, the wage data upwards during the pandemic and downwards. Now, what we of course really have to see is to what degree there's really bottlenecks, sustained bottlenecks in the labor market beyond the sort of effect of the higher unemployment benefits in the U.S. over the summer. That's supposed to fade. That should then give us a clearer picture of where the economy really is, and that is, I guess, why the Fed is not going to make a taper announcement before, say, September. So before we have more clarity on the distortions in that labor market data.
The ECB looks even further away, right? I mean, we've already heard, I think it was Villeroy who said the ECB will be supportive at least as long as the U.S. So they want to hold out a little bit longer than the Fed. But now we hear from Isabel Schnabel that overshooting would be okay. So do you expect the ECB to change their close to but less than 2% target?
Well, the ECB is in a period at the moment where lots of people have different opinions, so we don't really have the one ECB view at the moment. I think that's very visible in for instance, the two that you just mentioned, Villeroy and Schnabel. So Villeroy stands out at the moment for having this Fed perspective, which really points to an exchange rate risk. He wants that the ECB is at least as dovish and for longer probably than the Fed, which would suggest that he wants the euro a little bit lower. That's his view. Now, Schnabel's comment was really interesting because she didn't say it's okay if inflation overshoots. She said it's necessary, and that I think is really the fundamental question when it comes to the ECB strategy review at the moment. Does the ECB target above 2% inflation, or does it just accept above 2% inflation? If it targets it, then it's really taking its price stability target seriously. Then we have a form of, if you like, average inflation targeting like the Fed has. I think more likely, though, is that they just accept overshooting inflation, and that just introduced this symmetry around 2% effectively, which is a little less aggressive and allows them more to take the side effects of their policies into account. On, for instance, the incentives of governments to borrow, or on market functioning, risk-taking, the reach for yield and all of these side effects. That I think is what we're going to end up with: tolerance of above target inflation, but not targeting above 2% inflation.
In terms of the currency, I mean, you make a great point about Villeroy's focus here, and I saw a quote from him a couple of weeks ago saying that their main job is defending the value of the euro, not the stability of it, but the value of it, as in, making sure that it doesn't weaken too much against the U.S. dollar. And I wonder what we're going to see in terms of other central banks. They don't like to talk about currency being one of the motives in their policy actions, but we all know they are.
Well, they're effectively not allowed to, right? Because of the various IMF accords. They don't want to be manipulators of their currency. But of course, the smaller the economy, the bigger the impact of the exchange rate on inflation is. And especially if you're at the lower bound, like in particular the ECB is, you don't want the currency to throw an extra curveball in there. So they do have that in their mind, or at least some on the council have that on their mind. I think it's a traditional French view in particular, or Southern European view, that if the euro is weaker, that helps execute the task of getting inflation back to target. Whereas it's more of a northern view that the strength of the currency says something about the prospects of your economy, and therefore stronger euro is ultimately a positive thing. But it is. In the end, it is a side issue. The real issue at the ECB is how seriously do they take their mandate of price stability? Is everything secondary to that? Or are they really so worried about some of the side effects that they're just maximizing the probability of reaching their 2% targets, subject to not, distorting the markets too much?
Christian, I spent the weekend at beer gardens here in Germany with some fairly conservative families, all of whom wanted to exile Jochen Low, possibly banish him from all German-speaking countries if possible. But the second biggest topic of conversation was Armin Laschet. All of these people who want to vote for the CDU don't want to vote for Armin Laschet. I wonder what your take is on that.
Yeah, it's not the race of the three most popular candidates at the moment, you'd have to say. It's not just Laschet, who's not particularly popular with voters, the Conservative candidate. It's also the Greens candidate, Annalena Baerbock, who had a very good start when she was appointed in April, but since then has been crashing back down to earth, which leaves the finance minister, Olaf Scholz, as the most popular candidate, but unfortunately as the candidate of one of the least popular parties.
Popular party.
Indeed. So it is a bit of a mix again at the moment. But if you look at the polls, I think the one thing is clear, that voters are happy with a Conservatives-Greens coalition, however unattractive the two candidates look at the moment. Voters like that mix. That is our base case. That has been our base case for quite some time. And it has some potential in terms of policy because it unites the Greens' ambition on the fiscal side, for instance, and on Europe, with the CDU's muscle to actually get it through Parliament, because some of the things will need solid majorities in Parliament. So once the CDU is convinced that the aims that the Greens have, such as, of course, the climate targets, but also the European integration target, the fiscal, the extra public investment, once the CDU is convinced of those, we've got the muscle to actually get it through Parliament.
Christian, thank you so much. Thank you for all those insights. That's Citi's Christian Schultz. Now, coming up, we're going to turn back to oil, where the standoff continues. The OPEC Plus alliance meets again today to try to resolve an impasse over future production. We'll get the latest. That's up next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Markets. I'm Matt Miller in Berlin with Danny Berger in London. Now, the standoff within the OPEC Plus alliance as Saudi Arabia has pushed back against the UAE's opposition to a proposed production increase continues. In an unprecedented move, both countries have aired their grievances on television. First, UAE Energy Minister Suhail Al-Matroui spoke to our Manus Cranny in Dubai.
And just to be clear then, sir, you've not threatened to leave OPEC, and right now you're not prepared to threaten to leave if you don't get a deal.
No, I think if we don't get a deal, then we have an agreement to fulfill. We are not now close even to elapsing that agreement. We are not threatening to walk away from the agreement. We're not threatening. We haven't threatened anyone. UAE is not going to be an obstacle in front of anyone. But we are not going to threaten. That is not our strategy. We have been sacrificed. We sacrificed a lot. We will continue to sacrifice until the end of this agreement. That's our commitment. But beyond that, we have the right to discuss, and we demand to have the time to discuss and put our grievance in front of the group.
Now, responding to the UAE, Saudi Energy Minister Prince Abdul Aziz bin Salman spoke exclusively with Bloomberg's Anne-Marie Hordern.
I would emphasize that it is the whole group versus one country, which is sad to me, but this is the reality today.
And how concerned are you if there is no agreement and potentially we could see what we saw last year, which becomes a price war?
We have an existing agreement, Mary. I keep reminding people, unlike what you had in March, we have an existing agreement. We will honor that agreement. We will continue with it. The agreement requires that we bring more production, yes, but to complete that, honoring the agreement, we should kickstart what is mentioned in that agreement, which is we have to extend. Again, the extension put lots of people in their comfort zone. It brings volumes to address the short term, but it also addresses for the market. Check with all those who are participants in this market. Tell them.
The current agreement, if not extended, has no production increase for August. So if not every member signs up tomorrow, what happens in August?
Well,